Okay, in this video we're going to discuss third quarter results of Newmont, and I know it might seem like a busy screen, so let me explain you what we're going to do. On the left third of the screen we have operating and financial statistics of Newmont. We're going to look at third quarter of 24 compared with the second quarter, and here I'd like to focus on gold production with the guidance, cost applicable to sale with the guidance, all-in sustaining costs with the guidance, and then we're gonna skip for a moment the financial metrics here and look at the capital expenditure and in particular sustaining capital with guidance. So I'd like to spend a bit more time on the sustaining capital. Then we're gonna link those numbers to the comments that were provided by the management on the press release for the third quarter. And finally, we're gonna look at the key points from the Q3 earnings transcript and a management discussion, and also some points that have been made during the Q&A session with the analyst. So, with this in mind, let's get started. Okay, the total attributable gold production for the third quarter of 24 was around 1.7 million, and those numbers in the 1,000 ounces. So, rounded up is going to be 1.7 million. This was 3.8% higher compared to the second quarter, which was mainly driven by a 9.2% increase in managed T1 portfolio, which represents 63% of the total attributable gold production. Attributable co-product gold equivalent ounces production was down 10% at around 430,000 ounces. And those are metals like copper, silver, zinc, and lead that Newmont produced alongside the gold that it mined. I believe the copper represents around 37,000 tons of this co-product gold equivalent ounces. The guidance for the fourth quarter of 2024 is at 1.8 million ounces. This is 7.9% higher compared to the 1.7 million ounces produced in Q3. And I'd like you to visualize those numbers and show you how much gold that is. So we have here 1 ounce of gold, which is 31.1035 grams if we're gonna convert this to the imperial metrics. So here I have a 400 ounces gold bar. This weight 12.44 kilograms. So if we were to take the gold production of 1.7 million ounces that Newmont produced in third quarter, we would need around 4,170 of those gold bars. Now let's try to visualize that further. If we were to take a pallet and try to load all those gold bars to the pallet and arranging them 17 in a row, 5 bars across, and stack them one on top of another for the height of 17, we'll get the gold pallet of 1,445 gold bars per pallet. So given the production of 1.7 million ounces, we need approximately 3 those fully loaded gold pallets to get this production. So that's how much gold Newmont produces in just one quarter, 1.7 million ounces. Now let's move into costs discussion. And before we go to the costs, things like cost applicable to sales. Let me change the color here again on the go. I'd like to remind what are those costs and why are they significant. So we have cost applicable to sales and all-in sustaining cost there. And all-in sustaining cost is a standardized cost metric used by gold miners, and the cost applicable to sales is its largest component. So the cost applicable to sales include things like labor, energy, and royalties. So, and let me show you the Newmont gold outlook for Q3 2024 to give you an idea what are we looking at. So we have here all-in sustaining cost. All-in sustaining cost per ounce, right? That's the number we're looking at. We have here 1475, which corresponds to the guidance of Q4 of 1475. All right, good enough. What are the main components, and first of all, how are we doing that? So we have here all-in sustaining cost, which is the sum of all those numbers that we're then going to divide to ounces of gold sold. And we've divided one to another, we get the all-in sustaining cost per ounce. All right. So all-in sustaining cost By far, the largest components for the all-in sustaining costs are costs applicable to sales and sustaining capital. And you can see it here yourself. Those two are the largest components of the all-in sustaining cost. You have different things like reclamation cost and project and exploration and the refining cost, but those two are the biggest. Alright, so with this in mind, let's have a look at the cost applicable to sales. Gold cost applicable to sales consolidated was 1207, 4.8% increase compared to the second quarter, and those increase was along the whole portfolio, including managed T1 portfolio, non-managed T1 portfolio, and non-core assets. Now, the good thing is that the guidance for the Q4 2024 is 1050, which is 13% lower compared to Q3. Total gold all-in sustaining cost was 1611. That's 3.1% high compared to the second quarter. And have a look at the non-core assets. The all-in sustaining cost there is 1967, which was 11.1% increase compared to the second quarter. And I believe that's one of the reasons that Newmont decided with the non-core divestment asset, because those non-core assets, they really dragged all-in sustaining cost up. The guidance for Q4 2024 was 1475, and that was 5.4% higher compared to the guidance provided in the second quarter for the year end. And here is where the market reacted negatively. If you remember back in October after the earnings release, the shares decreased in price, and the main driver was indeed those all-in sustaining cost guidance, which came higher than expected. Let's have a look at the comments here. So first of all, with the production, I forgot to mention, we know that the guidance for Q4 was 1.8 million. The year-to-date production as of Q3 was 4.95 million ounces. If we add the guidance of 1.8 million ounces, we would get to 2024 estimates of 6.75 million ounces, around 12 those gold pellets. However, the picture changes when we go to the 2025 gold production. 2025 gold production is forecasted at 5.6 million ounces, which is 400,000 ounces lower compared to the February estimates, and they're impacted by a lower output at Lihir and Brucejack. And we have at Lihir 100,000 ounces less. Lihir is the gold mine in Papaya, New Guinea, and 250,000 ounces less in Brucejack, that's a mine in Canada. Moving on to the cost applicable to sales, as we saw here, they increased 5% due to higher direct operating costs, primarily due to increase in contract services. Let's move straight to the next point because it will make sense here. Labor costs rising, especially in contracted services, represent 20% of cost structure. 50% of labor of Newmont is contractual labor. So we have rising costs in contract services, including the contracted labor. It makes sense that cost applicable to sales will increase. The fact that the 20% of cost structure is contractual will affect the 2025 guidance. And in that sense, it will affect the guidance negatively because the costs are rising. One thing is, during the earnings call, the management mentioned the positive correlation between the gold price and the rising, and the inflation, basically. Gold serves as a hedge against inflation, and if the gold price is rising, it's good for the company, but so that the cost, they're also rising, which is negative for the company. So that was one of the things that management mentioned in the Q&A session of the earnings call. Let's move to the all-in sustaining costs. They increased 3%, and we saw it here, they increased 3% due to high cost applicable to sales. So we know that. This is interesting. It might increase further due to higher sustaining capital. And given what management said here, I'd like to spend a bit more time on the sustaining capital. We have here the capital expenditures, which was 877 million, 9.6% increase compared to the second quarter. Sustaining capital represents around 55% of those CapEx. 45% is represented by developed capital. What is interesting here is that the current CapEx increase was mainly driven by development capital, but if we look at the guidance for Q4 2024, sustaining capital is guided at 550, which is 16.6% increase compared to the current sustaining capital expenditures. Why is that important? Why I want to spend so much time here? If we look back to the this little table here, that was the 2024 outlook for gold that was produced by Newmont for the fourth quarter of 2024. We said that the biggest items are the cost applicable to sales and sustaining capital. So what's going to happen is that if we hold all else equal and your sustaining CapEx increases, this is going to increase the all-in sustaining cost, which will put upward pressure to the all-in sustaining cost per ounces. So the fact that we have our sustaining capital that is rising and projected to rise further is a bit alarming. So if we move from the all-in sustaining cost to the sustaining cost here and have a discussion here, sustaining CapEx, they are focused on Cadia tailings facilities, which may result in an annual sustaining capital spend of around 1.8 billion over a few years from core portfolio. And that's a bit alarming. That's higher than was projected in February, and this will put pressure on the all-in sustaining cost. Now you may wonder what is happening with this Cadia tailings facility and why they spend so much capital there in the Cadia. So let me explain you that. If we're gonna scroll down. So here is what happened. In 2018, earth movements caused a slump in the southern wall of the northern tailings facility at Cadia. Let's discuss what is a tailings facility in the first place. Here I have a gold processing flow sheet that shows you the whole process it takes to convert ore that's been just mined into one or another output of gold, be it a gold concentrate or doré. So we have ore as an input, and we have output like concentrate or gold ore. Now another output we have is waste, or what we call tailings. And here we have a tailings storage facility, which is specially designed storage area where the leftover material is safely stored. Why do we have this leftover material? Well, when the gold is mined, only a small proportion of it contains gold. In fact, getting 5 grams of gold per ton of ore is considered high grade. So only 0.0005% contains gold. The rest is waste. All this material is waste. We have to deal somehow with the waste, and there are two possible ways we can deal with it. The first way is to use spaced backfill plant. What is it and why do we need it? Let's say we have an underground ore body. So we're gonna drill the hole, and we're gonna decide to mine this section of the ore body. And we're mining until the slope of the ore body is fully mined. Now, before we continue to mine this section of the ore body, we have to reinforce the mine out area to minimize the chance of the ore collapsing. That's where the paste backfill plant comes into play. So we're going to take all this waste that we've mined, primarily rock and water, and we're going to fill in this mined out area until the slope is fully filled in, and only then we're going to move to the upward part of the slope and start to mine it. When this part of the slope is reinforced. And that's one of the ways how we can use the leftover material via the paste backfill plants. By the way, this method I've described here is called the sub-level stoping method. So that's one of the ways we can deal with the waste or tailings. The second way is to use the tailings storage facility. And why do we need those tailings storage facility? Well, during the gold processing, we use loads of chemicals. For example, here in carbon in leach circuit, we use cyanide, which is very toxic, to dissolve gold. So we dissolve gold, that goes to the further processing steps to become gold d'or. The leftover material, which is highly toxic, undergoes cyanide destruction process to make it less toxic, which is then moved to the tailings storage facility for the permanent storage. That's what those tailings storage facilities are for. Now, what happened at Cadia is one of the wall of the tailings facility slumped, making all the tailings to leak to an undesired area. In fact, in this case, the undesired area was one of the Cadia's open pit mine that was used as a temporary storage facility. Let me show you the picture of that. Here is part of the wall that collapsed. It had a diameter of 400 meters, and the length of the whole wall was 6 kilometers. This happened in 2018, and back then Cadia was mine of Newcrest. Newmont acquired Newcrest in 2023, so Newmont inherited this problem. Back then, Newcrest decided to use one of its open pit as a temporary tailings storage facility. So in fact, what you see here used to be open pit, and all the tailings flow into this open pit. So while there was a workable temporary solution, Newmont is focused on more sustaining and long-term solution. And this explains why you would expect 1.8 billion annual sustaining CapEx at Cadia. So, given our discussion here of the gold production and the cost and the sustaining CapEx, I think here is what's likely to happen. Well, first of all, let's discuss the Q&A during the earnings call. One of the analysts asked the rather direct question. He asked, is this a 5.5 million ounces, $1,500 per ounce all-in sustaining cost type of company going forward? And the answer was pretty much yes. The answer was that the cost escalation trends will follow through. And again, those are mostly a 20% cost structure that is contractual. They say those cost escalation will follow through, and they're focusing on getting to 6 million gold under 15,000 ounces copper run rate per year. And if I may provide my analysis, that's I think what's a bit alarming with Newmont. We know that their production is going to decrease. So first of all, that's ounces sold, not production, but for the sake of argument, decrease in production leads to decrease in ounces sold. That's logical. So the ounces sold going to decrease. We know the sustaining capital going to increase. It's increasing due to the tailings facilities at Cadia. For the argument's sake, let's say that we have the same cost applicable to sales. Let's just hold this constant at 8.85 million. Let's say the sustaining capex, they say it's going to be 1.8 billion per year. So it's about 450,000 per quarter. So instead of 125 by 450 here, which means all-in sustaining costs, it's going to increase from 25.30 to 25.55. And the ounces sold, so the goal is 6 million ounces run rate. So it's 1.5 million ounces per quarter. So if we're going to just calculate those, all-in sustaining cost of 25.55, but it's billion, so it's going to be billion divided by ounces sold, which is going to be 1.5 million, we said. We're going to get at around $1,687 per ounce all-in sustaining cost. Now, I'm not saying this is what's going to happen. I'm not saying that. I'm just saying that if we hold all else equal, even the cost applicable to sales, the combination of raise in the sustaining capital with a drop in the gold production, which will lead to the gold in ounces sold, will lead to an increase in all-in sustaining costs. And that is what might be alarming. And now, of course, the cost here we hold the cost applicable to sales constant, which is not true, as we're going to see in a moment. They have the divestment program, so probably they're focusing on the decrease in the cost applicable to sales to keep the all-in sustaining costs in check. But again, on the Q&A, the question was, is it 5.5 million ounces, 1,500 all-in sustaining cost type of company going forward? And the answer was pretty much yes. So I think this 1475 guidance for the Q4, it's not the limit yet. I think there is a chance it can be even higher. Okay, let's have a look at some key financial metrics for the third quarter. Let me zoom it in a bit. Average realized gold price increased 7.3% over the course of third quarter to $2,518 per ounce. And for Q4, for example, the average gold price was $2,663 per ounce. In Newmont's pricing assumption, they say that an increase of $100 per ounce of gold should lead to approximately increase of $550 million in sales. So we know that the average realized gold price increased by almost $170. So given this proportion here, I would expect the sales to increase to $935 million. Now the actual sales increase 4.6%, or $200 million. So which is lower than what the model would suggest. Now there are multiple reasons why the actual numbers different to what the model suggests. Well, first of all, the model was done in February and assumptions might have changed since then. The second big factor might be the depreciation of the Canadian dollar. In the same pricing assumption, Newmont says that the change of 5 cents of the Canadian dollar should lead to $60 million drop in revenue. While I was skimming through the video, I noticed a mistake I made. Please ignore what I've written here about the change in Canadian dollar. That is completely incorrect. First of all, the sensitivity refers to a 5-cent change in the Canadian dollar, not in US dollar. Second, this change impacts costs, not revenue, since Canadian operational expenses are denominated in Canadian dollar. As of third quarter, Newmont had 5 operating sites in Canada, and a strong CAD is a headwind for Newmont because those CAD-based costs become more expensive when translated to US dollar. In third quarter, the CAD averaged about $0.73, slightly below Newmont's assumption of $0.75, which means the company saw a small cost benefit, not a revenue impact. Apologies again for the confusion here. So what I'm trying to say here is that there might be multiple reasons why the actual change in sales different to what the model would suggest. Okay, so with this, let's continue looking at the financial metrics. So sales were at 4.6 billion in the third quarter and 4.6% increase quarter over quarter. The majority of it, the biggest portion, was gold. Adjusted EBITDA was at 1.97 billion, cold flat quarter over quarter. Net income was 924, 7.8% increase. Earnings per share 80 cents, 8.1% increase. And adjusted EPS 81 cents, a 12.8% increase. Moving on to net cash provided by operating activities, it was at 1.65 billion and 15.4% increase. Of course, we've discussed already capital expenditures previously, increase of 9.6% to 877 million, mainly driven by an increase in the development capital, which was at 12.5%. The guidance going forward, as we discussed, is going to be increase of 13.8% for the sustaining capital at 550. And finally, moving on to the free cash flow, it increased dramatically to 28%, and the free cash flow for the third quarter was 760 million. And finally, let's have a look at the key points made by the management during the earnings call. Newmont has made a meaningful progress on its non-core divestment program, and it is on track to generate $2 billion in gross proceeds by 2024. And I'm sure they are. Let me scroll to the bottom of the screen. Here I have a timeline with information on the sold mines. In fact, not only did Newmont manage to generate $2 billion in gross proceeds, it also managed to successfully sell all its 6 non-core mines that were part of the non-core divestment program and that were held for sale on its balance sheet. Let's quickly have a look at those mines. And so I have here a timeline and with the dates and with some basic information about the mines that were sold. September 10, sale of Telfer, that's a mine in Australia, for 475 million gross proceeds, in return 7.5 million cash. October 8, sale of IKM for 1 billion cash, that is mine in Africa. November 18, sale of Musselwhite for up to 850 million. This is mine in Canada. November 25, sale of Eleanor, mine in Canada for 795 million cash. December 6, sale of CCNV, which stands for Crimpel, Crete and Victor. It's a mine in the USA for 275 million, which includes 100 million cash. And finally on January 27, that was this year, sale of Porcupine for, I hope it pronounces right, Porcupine. It's a mine in Canada for 425 million, which includes 200 million in cash. That is very good. That is very good. Newmont managed to sell all its 6 non-core assets. I think that's a very good result. And why it's a good result? Well, if you remember, when we discussed all-in sustaining cost, we said that the non-core assets represent a very large portion of the costs. So given that the all-in sustaining cost per ounce from the non-core assets is much higher than the total all-in sustaining cost, those non-core assets were pulling the all-in sustaining cost up. So now, as Newmont managed to eliminate those non-core assets, effectively it's eliminating all those costs associated with those non-core assets that was putting the upward pressure on the all-in sustaining cost per ounce. And remember here, when we discussed this little table, well, actually, you know what, let me just delete all those things we don't need anymore. Right, so when we discussed this section, we said that the cost applicable to sales and the sustaining capital were largest contributors, the largest component of the all-in sustaining cost. The cost applicable to sales, those non-core assets, those 6 mines, they represented, I believe, 20% of cost applicable to sales and 25% of sustaining CapEx. So as Newmont now successfully divest those operations, it's effectively lowering the cost applicable to sales and sustaining capital. Now, of course, we know here that the Newmont expects sustaining capital to be at 1.8 billion, as discussed previously, but still 25% in sustaining capex savings, I believe, is not a bad result, and same goes for the 20% cost applicable to sales. So I think what's going to happen is that the decrease in the cost applicable to sales and sustaining capital going to outweigh the decrease in ounces produced and ounces sold from those lost 6 operations. And I believe that this should put the downward pressure on the all-in sustaining cost. So again, good results here in this non-core divestment program. Let's look further. By the way, these 2 billion in gross proceeds which Newmont received was on top of 527 million in cash proceeds that Newmont received from the Lundin Gold transaction. And I believe this transaction was done April last year. Newmont has special agreement with Lundin Gold, and in fact, when we're going to look at the global operations of Newmont, we're going to see that Newmont report the gold production for the Fruta del Norte mine for the first quarter using the equity methods. By the way, this Lundin Gold, that's a Canadian gold miner, a very small Canadian gold miner. I believe the gold production for the third quarter was 122,000 ounces for Q3. And that's compared to the 1.7 million ounces produced at Newmont for the same period of time. So it's a small company, but man, this company is effective. The all-in sustaining cost per ounce for the third quarter was at $877 per ounce. That is one of the lowest cost gold mine in the world, in fact. We're going to have more to say about this Lundin Gold once we get to the P analysis. Let's move on. So the Newmont also retired 233 million in debt with a cash cost of 210 million. That's good. Repurchased 9.4 million shares at the average price of 53.16 for a total cost of 500 million. So we have the average cost here of 53.16. For your reference, the average year-to-date price of Newmont this year was somewhere around in the range 40 to 45. And Newmont share price was at 57 before the earnings release, and after the earnings, of course, the price dropped. I believe it was dropped to 40, and then it's continued drifting down to the strong US dollar. And beginning of the year, it starts its rebound due to the market volatility, and year to date, it's somewhere around $40 to $45 per share. Newmont also authorized additional 2 billion shares repurchase program to be executed over the next 24 months. Good. That's one of the most effective way to return capital to the shareholders, and it's also one of the most tax efficient way. In total, Newmont returned $786 million to shareholders through share repurchases and quarterly dividends. The dividends per share at Newmont is 25 cents per share. Newmont has 1.15 billion shares outstanding, so the total amount of quarterly dividends is 286 million. If we add the 5 million from the share repurchases, we get to the 786 million of total shareholders returns. Newmont achieved 500 million in synergy run rate from Newcrest acquisition. Newcrest was acquired in 2023, and as part of this acquisition, Newmont made commitment to achieve those 500 million in synergy run rate. 100 million was achieved from the general and administrative, 200 million from the supply chain, and 200 million from what Newmont calls the full potential program. By the way, 65% of this full potential was achieved from Cadia, and mines like Cadia and Delaware were acquired as part of the Newcrest acquisition. We also have 3 projects in execution, and when we get to the earnings call, the management makes the reference to those 3 projects in execution multiple times. So let's have a look what those projects are. It's a second expansion of Tanami, that's a mine in Australia. Ahafo North, that's a new mine in Africa. And Panel Caves at Cadia, this is, as we know, in Australia. So those are the 3 projects in execution: the Tanami, Ahafo North, and Cadia. Finally, Newmont focuses on optimizing portfolio of 11 managed T1 operations with firm focus on expanding margins versus chasing volumes. Okay, so I know it was rather long introduction, but I think we had a good overview of what happened with Newmont in the third quarter. So while we see clear improvements across the several financial metrics, I think that ongoing high sustaining CapEx and elevated all-in sustaining cost will remain a headwind for Newmont, at least in the near future. That's why I believe that the recent year-to-date price return of Newmont, just under 20%, is somewhat overdone, even considering the record high gold prices. I think the market might be disappointed on the 20th of February when Newmont releases its full year results. That's also when we'll likely get the outlook for 2025 with guidance. And it's not because of the current results. I'm sure that the gold production and top line revenue will be higher, but rather because of Newmont's projected all-in sustaining costs going forward. And I want to remind you that after the third quarter earnings release, the price has dropped all the way from $57 to $45 to just under $40. And I believe that the lowest price for the period was around $37. All when the gold price per ounce was increasing. And while it is true that the part of this was due to the strong US dollar after election result, the drop from 57 to 45 was due to the elevated all-in sustaining cost per ounce guidance, and not due to the third quarter results, which was good. So I think while trailing numbers for financial year 24 will look good, forward-looking cost pressure will matter more. And again, expected to be due to the higher CapEx, specifically sustaining CapEx, which will remain elevated, leading to higher all-in sustaining costs per ounce. And it wouldn't surprise me if it will stay at or above $1,500 per ounce in the coming years. Now, I know it might be confusing to try to understand which mine is where, given how many mines we've discussed here. And of course, given that Newmont is the largest gold producer, why don't we pinpoint Newmont's operations around the globe and introduce some basic operating statistics? I think it might help us to get nice bird view overview of Newmont's operations, which in turn should help us to know where we should pay attention to. So let's do that. Here is an overview of Newmont's operations around the world. And if you're wondering where this came from, just head over the Newmont's website, click on Operations and Projects, and you'll find this overview. It is interactive, so you can click on each mine for more details. Let's go over the legend real quick. In dark blue we have managed operations. These are mines that are wholly owned and operated by Newmont. In light blue we have joint ventures. These are operations where Newmont hold a non-controlling interest and does not have full operational control. And this is in orange, projects in execution. This symbol here, a triangle inside a circle, represents a world-class T1 mine. I've also included the key characteristics that mine must meet to be classified as T1 asset, and there are 4 of them. Production of more than 500,000 gold equivalent ounces per year, all-in sustaining cost per ounce in the lower half of the industry cost curve, expected mine life of more than 10 years, and operations in countries rated A or B by Moody's, S&P and Fitch. Now let's take it a step further by adding information we already know. We know that Newmont has agreed to sell all 6 of its non-core operations, so let's see where they are located. We have 1 here in Australia, Telfer, 1 in Africa, Cadia, 1 in the USA, Crimple Creek and Victor, and 3 in Canada, Musselwhite, Eleanor and Porcupine. And you can see more details in these boxes. So this addition to a legend is non-core assets agreed to sell. From the previous screen we saw that after successfully executing its non-core asset divestment program, Newmont is aiming to focus on its portfolio of 11 managed operations, 6 of which are T1 assets. Let's check if that's what we see on this map, and we'll ignore the assets agreed to sell since they are irrelevant going forward. In Australasia, we have 4 T1 operations, 3 in Australia, Boddington, Cadia and Tanami, and 1 in Papua New Guinea, Lihir. In Africa there is 1 T1 asset, Ahafo, and in Mexico there is 1 T1 asset, Penasquito, bringing the total to 6 T1 operations. Additionally, we have 3 managed operations in Southern America. Those are Marian, Cerro Negro and Yanacocha, and 2 in Canada. This is Brucejack and Redcrest, bringing the total number of managed operations to 11. Beyond these, there are 3 non-managed T1 assets: Nevada Gold Mines, a joint venture with Barrick Gold, the world's 2nd largest gold mining company, where Newmont holds 38.5% interest, accounted for using the proportionate consolidation method. Pueblo Viejo, a joint venture with Barrick Gold, where Newmont holds a 40% interest, accounted for using the equity method. And Fruta del Norte, a joint venture with Lundin Gold, which wholly owns and operates the mine. Newmont holds 32% interest here, also accounted for using the equity method. So to summarize, Newmont has 11 managed operations, 6 of which are T1 asset, and it also has 3 non-managed operations, all of which are T1 assets. Now let's take a look at some key operating metrics that we already seen at the aggregate level, and I've added it here, so let me zoom it in. We'll look at attributable gold production and co-product gold equivalent production, and where applicable for mines that produce other metals such as copper as a co-product, we'll sum it up to get the total co-product gold equivalent ounces production. I've also added cost applicable to sales per ounce for reference, but I will be focusing on all-in sustaining cost since it already provides the key cost story. These metrics will be shown for both the full financial year of 23 and the last 3 quarters of 24. Additionally, I've included 23 figures as a reference so we can compare each mine's performance to Newmont's total operations. Next, let's add another layer of operating metrics to get a sense of size and production patterns of specific operations. First, we have a total amount of ore mined expressed in million tons. We also have abbreviations here. O stands for open pit mining, while U stands for underground mining. Then we look at the total amount of ore processed, also in million tons. M stands for milling, while L stands for leaching, which are 2 primary methods for gold processing. I'll explain the difference between these in detail shortly in a different screen, but let's finish this part first. Next we have the average ore grade expressed in grams of gold per ton of mining, and we have average recovery rate expressed as a percentage. Then we'll see the total amount of gold reserves, which include both proven and probable reserves, with proven reserves having the highest confidence level. And finally, we have total gold resources, measured, indicated and inferred, where measured resources have the highest confidence level. These are all expressed in millions of ounces. A quick distinction: resources include the estimated mineral deposit, both economic and uneconomic. Reserves include only economically mineable portion of resources. Again, proven reserves have the highest confidence level. Now, resources can become reserves if gold price increases, making the higher cost extraction economically viable. And remember Mark's example in the original Understanding Gold Mining video about the huge gold deposits at the bottom of the ocean. While they exist as resources, they are likely to become reserves in the foreseeable future, at least, due to the high extraction cost. And that's the key difference between reserves and resources. Lastly, I've included a formula here that we can use to estimate gold production based only on the information above, and I'll show you how we can use the data provided to apply this formula. But before we move on, let's first discuss the difference between the two gold processing methods, milling and leaching, and I'll do it on a separate screen. Okay, gold processing. I don't know about you guys, but when I first heard about the gold ore, I had something like that in mind. I was thinking about the loose gold nuggets, or maybe a person, probably from the Western movie, panning the gold and trying to get those small gold particles that he then can smelter and get the gold ore. It turns out that at the industrial level of production, it is highly unlikely and very rare to see this type of process. What is more realistic and more common form of ore, it is this. Now, if I were to ask you what is common among all those rocks, the correct answer would be that all those rocks contain embedded gold. It is different type of ore, but what they share in common is that they all have gold locked in it. And the gold processing is a series of steps to extract gold from this ore. That's what the gold processing is all about. And it's a bit funny that when we think about the gold miners, we're thinking primarily about the gold mining itself, while in fact the gold processing is also a substantial part of the process. So let's discuss the gold processing. Okay, this is the gold processing flowsheet that we saw previously, and this specific flowsheet describes the milling process. And there are two methods we can use to extract gold from the ore. That's what the gold processing is all about. There is leaching and milling. Leaching has only 3 steps. It is crushing, cyanidation, or leaching, thus the name, and refining. Milling has extra steps because the ore that is used in milling requires pretreatment. So in milling we have crushing, followed by milling, flotation, oxidation, cyanidation, and refining. So you can see those are the extra steps we use in milling. And to visualize that in our flow sheet, we have here input and output. First step is crushing, followed by milling or fine grounding. We have flotation here, cyanidation, and this is refining. And if you pay attention, there is one step missing. This is oxidation. This particular company mostly produce gold concentrate as an output. So in gold concentrate, you don't really need oxidation or cyanidation. The gold is still locked in the sulfite. So that might be the reason why they don't include it here. Although they include the cyanidation, so it's a bit strange that they didn't include it here. Anyways. And this is tailings management. Remember this wall that slumped at Cadia? So how do we decide whether to use milling or leaching? It all comes down to the process bottleneck, where most of the time is spent. If it is in milling and fine grinding the ore, it's a milling process. If the bottleneck is in leaching, where gold extraction takes the longest, then it's a leaching process. And what does our choice of processing method depends on? Depends on the type of ore we are mining. We use leaching to extract gold from oxide ore and milling to extract gold from refractory ore. Oxide ore is associated with oxide, that in turn is associated with oxygen bound to other element. Refractory ore is associated with sulfide ore, that in turn is associated with sulfur bound to other element. What's the most common oxide everyone has seen? Rust or iron oxide. If we remove this part, we get hematite, a mineral that sometimes contains gold. However, gold is more commonly found in another oxide mineral, quartz or sand. And one of the most common sulfide ore that contains gold is pyrite. The key characteristics of oxide ore is that gold is not chemically bound with mineral, well, not strongly at least, which means that cyanidation works effectively. Because let's say you have an oxide ore here and you're going to apply the cyanide solution. This cyanide solution will effectively dissolve gold. So given that cyanidation works effectively, we can apply the method called heap leaching. Let me remind you what that is. Here we have crushed ore, which we're stacking on a 3-degree slope. We'll then place a network of sprinklers over the ore. And here, of course, we have impermeable layer so that the cyanide doesn't flow to the ground. We'll then apply a diluted cyanide solution through this network of sprinkles. This solution dissolves the gold, allowing it to flow down the slope, where it is collected as a pregnant solution, which is liquid rich in dissolved gold. And here is, of course, our impermeable layer to make sure that cyanide doesn't leak to the ground. Okay, let's guide our gold processing steps all the way to completion. So after we get the pregnant solution from heap leaching, we are doing the process called carbon in pulp. And what we're going to do, we're going to add activated carbon to increase gold concentration. Because in pregnant solution, the gold concentration is low. So we need to increase this gold concentration, and that's what carbon in pulp does. Then we're gonna do elution, and elution remove carbon from our solution. And next step is electrowinning. And electrowinning is a process used to extract gold from the solution using electricity. So what we're gonna add the current that will pass through the solution, which will cause the gold ions to stick to the cathode, which is usually a metal plate, forming a solid metal. So electrowinning recover gold from our solution. And then we're gonna do refining and get those beautiful gold bars. And that's how we extract gold from oxide ore using the leaching method. Now let's discuss the milling process used to extract gold from refractory ore. And we said that in oxide ore, gold is not chemically bound. In refractory ore, gold is both chemically and physically bound, which means that gold is locked inside the sulfide. So locked inside sulfide. What it means is that this refractory ore is resistant to direct cyanide leaching. Cyanide leaching. So let's say you have here a gold-bearing sulfide, and you'll decide to apply the cyanide solution here. What's going to happen is pretty much nothing going to happen. You're going to get the same sulfide locked with gold locked in it. The sulfide is simply too dense and solid for the cyanide to reach the gold. So we can't apply cyanidation directly as with oxide ore. We need pre-treatment. And the key pre-treatment method is pressured oxidation. Pressured oxidation, with autoclaving being the most common example. Here we have a pyrite, which we will treat with oxygen and some water at high temperature and around 30 bars of pressure. This process breaks down the sulfide, producing oxide and some residuals. And what do we get? Hematite. By applying pressured oxidation, we have successfully converted sulfide into oxide, allowing us to now use cyanidation to dissolve and extract the gold. And actually, before doing that, we saw on the flow sheet that before oxidation we do flotation. So let me quickly show you what flotation is and why we need it. So let's move this to here. Okay, so flotation. Sulfide minerals don't exist in isolation. They are locked within the waste rock. So in previous steps we were milling and grinding the ore and mix it with water to form a slurry, which contains both gold-bearing sulfides and non-valuable waste mineral. So we have this slurry here and gold-bearing sulfides are floating in the slurry. We can't just take this slurry and throw it into autoclaving. That'll be highly ineffective. First, we need to separate the gold-bearing sulfides from the surrounding waste rock, and here's how we do it. We have a flotation cell equipped with a mixer or alligator, and inside we have those gold-bearing sulfides that are flowing in a slurry. So what we're going to do, we're going to add the special chemical called collector, which will make the gold-bearing sulfides hydrophobic, meaning that they will repel the water. Then we're going to add air to the slurry, and what's going to happen, those tiny bubbles will flow up, and the hydrophobic sulfides will stick to the bubbles and will flow up as well. Those are the name flotation. So, and of course the slurry with the waste rock is will go to the bottom and then will be removed as part of the tailings management. We're gonna then take those sulfides and skim them to the separate pool to form what is called froth. And that's how we separate gold-bearing sulfide from waste rock. Now, important point to understand is that we have only separated gold-bearing sulfide, but not liberated the gold itself. The gold is still locked inside the sulfide mineral. To extract the gold, we use cyanidation, and with refractory ore before cyanidation, we need to use pressured oxidation. Because again, if you were to apply the cyanidation directly to this froth, nothing will happen, because again, the gold is still locked inside the sulfide. So that's where we need to use oxidation. So we have a triangle here: flotation to separate gold, pressure oxidation to convert sulfide into oxide, and cyanidation to liberate gold. The cyanidation process in milling differs from the one used in leaching. As we saw earlier, leaching typically uses heap leaching, where cyanide dissolves gold as it percolates through stacked ore. In milling, we use carbon in leach, a process that combines cyanidation and activated carbon to increase concentrate in a single tank, both dissolving the gold and capturing it. So similar to carbon in pulp, but in one integrated step. And the remaining steps are exactly the same as those used in leaching. So it's elution, electrowinning, refining, and finally gold ore as our final output. So let's reinforce what we learned, because I want to make sure that we understand what's going on here. This flowsheet shows the milling method of gold processing. Therefore, we can say with certainty that this particular company, which uses this flowsheet, mainly mines refractory ore. Therefore, they're using milling method. And milling is with double L. Let me correct that when I go. And here also. Sorry about that. Here we go, that's better. So that was for milling. If we see this method here, which is heap leaching, we know certainly that this is processing for oxide ore. So given what we've learned, let's go back to the first screen and see how we can apply it. Here we have gold-bearing quartz ore. We know the formula of quartz, we saw it before. We see it contains oxygen, therefore we can conclude this as oxide ore, and most likely the heap leaching or leaching method to extract gold is used. And we can sometimes determine the type of ore visually. For example, this ore mineral resembles rust, which forms due to oxidation. Therefore we can conclude that this is oxide ore. And we know the oxide ore with using heap leaching or leaching method. Here we have sulfite, and how we can visually determine that this is sulfite is that compared to oxide ore, which is porous, sulfite is solid and dense. So we've learned that with sulfite we use milling method to extract gold. And to reinforce, we also learned that sulfite ore is resistant to direct leaching, therefore pretreatment is required. And the pretreatment we use is flotation to separate gold-bearing sulfite from the waste rock, oxidation to turn sulfite into oxide, and carbon in leach, which is cyanidation to dilute or liberate gold. Oh, and by the way, the oxide ore is most likely associated with open pit or surface mining, and here is why. Oxide ore is typically found near the surface due to prolonged exposure to weathering and oxidation, which gives perfect conditions for oxidation. And here we have pyrite sand, which we saw previously is sulfite, and we even know the formula of pyrite. And as we can see, the sulfite ore is most likely to be found underground. And here we have oxide ore on the surface. So therefore we can conclude that the sulfite ore is most likely associated with underground mining. We will start with the Australasia region, a key area for Newmont's operations. This region is home to 4 out of 6 of Newmont's managed T1 operations, contributing 50% of production from managed T1 assets and 32% of total attributable gold production. It also holds 35% of Newmont's total reserves and 30% of its total resources, making it a crucial part of the company's asset base. We'll start with Telfer, which was the first mine announced for sale. Attributable gold production was 43,000 ounces in 23 and 51,000 ounces in the first 3 quarters of 24. The all-in sustaining cost per ounce was $1,988 and $3,823 respectively. Take a look at how that compares to the Newmont's average of $1,444. It's not surprised that Telfer operations were divested. In total, 6.4 million tons of ore were mined, with 2.8 million tons processed through milling at an average grade of 0.65 grams of gold per ton and a 73.2% recovery rate. Think about it, less than 1 gram of gold per ton of ore. We don't have the data for the total reserves, but we do know that the indicated resources stood at 0.6 million ounces. Now let me show you how we can use this formula to estimate gold production using this data here. So the formula says that the estimation of the gold production is the product of gold processed times ore grade times recovery rate, and we divide our conversion ratio because we have the gold production in ounces and we have gold processed in tons. So that's why we use this conversion ratio. So let's begin. We know that the gold process was at 2.807, and this is in million tons, times ore grade 0.649, and this is grams per ton, multiplied by the recovery rate, which is 0.732. It's going to give us 1.3335, and this is in million grams, because you have the million tons here and grams per ton over here. So when we multiply, the tons are cancelled and we're left with a million of grams. Let's use our conversion ratio to get to the ounces. So we know that the 1 ounce is 31.1035 grams, and it's going to give us 0.0428, and this is in million ounces. And we need thousands, so let's multiply by 1,000. We're going to get 42.8 thousand ounces. 42.8, 43. That's the beauty of this formula. You can use just this data here to estimate the gold production at a given mine. Moving on to Boddington, which was Newmont's largest gold equivalent ounces producing T1 asset in 23. Attributable gold production was 745,000 ounces in 23 and 426,000 ounces for the first 3 quarters of 24. Core product gold equivalent ounces production stood at 245 and 152,000 ounces, bringing the total core product gold equivalent ounces to 990 and 578,000 ounces respectively. So this is for financial year 23 and first 3 quarters of 24. The corresponding all-in sustaining cost per ounce was 1,067 and 1,289 respectively. In total, 61.5 million tons of ore were mined, with 36.5 million tons processed through milling method, an average grade of 0.75 grams per ton and 85.4% recovery rate. Total reserves stand at 9.6 million ounces, while measured and indicated resources stand at 4.6 million ounces. You can see the breakdown of proven, probable, measured, indicated and inferred here. Moving on to Cadia, which was Newmont's second largest gold equivalent ounces producing T1 asset in the last 3 quarters of 24. Attributable gold production was 97,000 ounces in 23 and 354,000 ounces for the first 3 quarters of 24. Core product gold equivalent ounces production stood at 90 and 355,000 ounces respectively, bringing the total core product gold equivalent ounces to 187 and 790,000 ounces. You may wonder why gold production at Cadia was significantly lower for financial year 23. The reason is that Cadia, along with Lihir, was acquired as part of Newmont's acquisition of Newcrest, which was completed in November 23. During the first 3 quarters of 23, Newmont did not report production for Cadia, as it was still under the Newcrest ownership, and consequently Cadia's production data was not included in Newmont's reports for that period. You can actually see this in the Newmont's 3rd quarter press release, and let me show it to you. So here we have the press release of Newmont, and that's the press release for the 3rd quarter of 24. And if we go to this page and look at the attributable gold production for 23, you can see that for the Cadia, it was not reported for the first 3 quarters. And that explains the low production for financial year 23. What is also interesting is that if you go to Newmont's website and check Cadia's operations, you'll see that for the 2023 fiscal year, Cadia produced 597,000 ounces of gold at an all-in sustaining cost of $45 per ounce. How is that possible? We just saw that the all-in sustaining cost for Cadia for financial year 23 was, let me scroll it to you here. We have Cadia here, all-in sustaining cost was at 1,271. How is it possible to get such discrepancy? This discrepancy comes from Newcrest so the company that was acquired by Newmont, use of the byproduct methods to calculate costs. Under this method, revenues from other metals, such as copper, is credited against the gold production cost, lowering the reported all-in sustaining cost per ounce of gold. And since Cadia is major copper producer, we can see it here, it's gold and copper. The revenue from copper sales was used to offset gold production costs, making the all-in sustaining cost appear much lower under the Newcrest reporting. And after Cadia acquisition, Newmont has been using the co-product method to calculate costs. And under the co-product method, there are no cost reductions from the byproduct credits. So each metal carries its own share of the cost. So that's the first and main piece of puzzle. The second puzzle is that Newcrest fiscal year ended in June 23, while Newmont's fiscal year ends in December 23. So when Newmont states that Cadia's all-in sustaining cost was $44 per ounce for the 23 fiscal year, they are actually referring to Newcrest fiscal year ending in June 23 and not Newmont's fiscal year ending in December 23. I hope it makes sense now. So back to Cadia, corresponding all-in sustaining cost per ounce was $1,271 and $1,044 respectively, and I would expect it to increase going forward due to the capital expenditures for the tailings facility. In total, 4.4 million tons of ore were mined, with 5.2 million tons processed through milling at an average grade of 0.72 grams per ton and 81.5% recovery rate. Total reserve stands at 14.7 million ounces, all classified as probable, while total resources amount to 20.6 million ounces. And again, you can see they break down here. Moving on to Tanami, a strong performing underground operations with high-grade ore. Attributable gold production was 448,000 ounces in 23 and 291,000 ounces for the first 3 quarters of 24. The corresponding all-in sustaining cost per ounce was $1,060 and $1,256 respectively. In total, 2.3 million tons of ore were mined, with 2.4 million tons processed at an average grade of 6 grams per ton. That's rather high. It's one of the highest ore grades among Newmont's operations, and given the high ore grade, it's likely a refractory ore. Total reserves stand at 4.9 million ounces, while total resources amount to 5.1 million ounces. Moving on to Lihir, an operations acquired from Newcrest with high sustaining cost. Attributable gold production was 134,000 ounces in 23 and 451 for the first 3 quarters of 24. The corresponding all-in sustaining cost per ounce was $1,517 and $1,416 respectively. On the high end, given that Newmont's average all-in sustaining cost is $1,444 per ounce. At Lihir, a planned shutdown of the primary autoclave is underway, along with some other improvement work to improve the operations. And as mentioned earlier, Newmont's forecast 250,000 ounces lower production at Lihir in 25 compared to previous guidance. In total, 6.4 million tons of ore were mined, with 2.1 million ton processed through milling at an average rate of 2.57 gram and a 76.5% recovery rate. Total reserve stands at 17.5 million ounces, and again, as with Cadia, all classified as probable, while measured and indicated resources amount to 20.2 million ounces. Now let's take a look at how this region fits into Newmont's overall portfolio. Managed Tier 1 operations in this region accounts for just under 50% of Newmont's total managed Tier 1 portfolio for the last 3 quarters of 23. These mines contributed just under 32% of Newmont's total attributable gold production. When it comes to reserves, this region holds 34.4% of total reserves and just under 30% of total resources. Let's discuss key operations to keep in mind. Cadia and Boddington ranked as Newmont's second and third largest gold equivalent ounces producing asset in the last 3 quarters of 24. And here I have the chart of the last 12-month gold equivalent ounces productions from Tier 1 assets. And if we're going to zoom it in, we see that Cadia and Boddington are ranked as second and third, while Tanami is ranked as the last one and Lihir is in the middle. In terms of gold reserves, Cadia and Lihir holds 14.7 million and 17.5 million ounces respectively. However, it is important to note that these are probable reserves, which have a lower confidence level than proven reserves. Both mines were acquired from Newcrest in 23, and if we compare Newmont's gold reserves growth from Newcrest acquisition in 23 versus 22, we'll see that the increase comes entirely from probable reserves, not proven reserves. Let me actually show you that. So this is the 10K, the annual report of Newmont for 23. And if we go here, this is the gold reserves at December 23. And I have here the same table for the December 22. So we see that the total reserves increased from 96 million ounces to 136 million ounces. But if you look at the proven reserves, it actually decreased from 24 to 22 million. So this growth in total amount of reserves is coming entirely from the probable reserves. And actually 83.3% of total Newmont's reserves are probable reserves. Couple of additional notes to be made about Cadia and Lihir, and for that we'll refer to Newmont's earnings call transcript. So this is the Newmont's earnings call for Q3 24. And this is Chief Operating Officer that is speaking here. Let's have a look at Cadia. Grades at Cadia are expected to continue declining in the fourth quarter. They're focusing on the tailings facility to maximize capacity. And these efforts are expected to continue to a period of increased sustaining capital spend at Cadia over the next few years. So that's actually what we saw on the first screen when we were talking about the tailings facility that will require 1.8 billion annual CapEx. Let's move on to Lihir. At Lihir, we continue to progress the planned shutdown of the primary autoclave. And when we see this word autoclave, what comes to the mind? We should think about the oxidation, pressured oxidation process, meaning that this mine, Lihir mine, is refractory ore. And actually, if you check it here to satisfy our curiosity, if we open Lihir, you're gonna see most of the ore that Lihir produces is refractory and treated using the pressured oxidation. So that's why the Lihir is involved in this shutdown of the primary autoclave. And this, of course, leads to the decrease in production. So at Lihir, they're focusing on reducing complexity and delivering more sustainable and predictable results. And this effort will result in lower than initially anticipated production next year. And gold production next year from Lihir will be around 250,000 ounces lower than Newmont's initial guidance for 25 that was provided back in February. So that's with regards to the management comments on Cadia and Lihir operations. And finally, let's take a look at Newmont's projects currently in execution. We see that the 2 out of 3 projects are located in Australia. We have here the projects in execution for Cadia and here for Tanami. Let's have a look at Cadia. The plant cave 2-3 development includes 2 caves to recover 5.9 million ounces of gold and 1.3 million tons of copper reserves. The cave 2-3 to produce 1 million ounces of gold and 400,000 copper over 10-year cave life. Cave 1-2 to produce 4 million ounces of gold and 700,000 tons of copper over 15-year cave life, and 275 to 325,000 ounces of gold and 35 to 55,000 tons of copper per year during peak production, which I expect to be from 2030 to 2040. And let me actually show you this, the cave expansion 2-3 and 1-2. This is the Cadia site tour done in November 2024. And if we have a look here, this is the Cadia open pit mine, and this is the underground facility. and we have 1, 2 and 2, 3 here. So 1, 2 in development, and the Commons cave establishment in 27, and cave 2, 3, cave established in Q3 24, big production expected to begin in 2027. You see that the shafts reach depth of 1200 and 1400 meters, and you see these tunnels here, they are ramps and declines designed to provide the access for trucks and equipment to transport ore. So all those lines are those ramps. Now let's have a look at the Tanami, secures Tanami. So this project in execution secures Tanami's future as a long-life, low-cost producer by extending mine life beyond 2040. And what you see here is the shaft. So that's the sort of the lift which is used to get to the underground ore. So let's have a look. 1.5 kilometer deep production shaft, reducing operating costs by around 30% through efficiency improvement. It enables future processing of around 3.3 million tons of ore per year, and annual production increases of 150 to 200,000 ounces for the first 5 full years. So those are those 2 projects in execution in Australia. That wraps up our discussion on Australasia operations. Now let's move on to the other regions. I won't go into as much details there as I did here, but will instead go through them quickly, highlighting the key operations. And if I miss something, just feel free to pause the video if you'd like to take a closer look at any specific operations. We'll now shift our focus to Africa region, which also plays an important role in Newmont's portfolio. This region accounts for 19% of managed portfolio, contributing 50% of Newmont's total attributable gold production. In terms of reserves and resources, Africa holds 8% of Newmont's total reserves and 5% of total resources. Here we have Cadia, which was divested as part of Newmont's divestment program. Since Newmont announces definitive agreement to divest Cadia for up to $1 billion, I won't go through the statistics, but you can see them on the screen if you're interested. We'll take a look at Ahafo, Newmont's key T1 asset in Africa. And for production figures, I'll only be stating the numbers, the all in 1,000 ounces for 23 and first 3 quarters of 24. Attributable gold production was 581 and 587 respectively. All-in sustaining cost per ounce was 1,222 and 1,057. In total, 27 million tons of ore were mined from open pits, with 2 million tons mined from underground. The mine processed 8 million tons of ore at an average grade of 2.4 grams per ton and 94% recovery rate. Total reserves stands at 9.2 million ounces, while total resources amounts to 6.4 million ounces. We also have 1 project in execution, Ahafo North. Let's have a look at it. Here is some information on Ahafo North project in execution, and if you're wondering what this massive drum on the photo is, it is SAG mill, which stands for semi-autogenous mill. And we saw in our processing worksheet as being the first step in grinding crushed ore. Think of it as a massive rotating drum like a giant washing machine, but instead of cloth it's filled with gold-bearing rock, water and steel bolts. Autogenous in semi-autogenous means self-grinding, so where rock breaks down by colliding with each other, while semi-autogenous means the process is partially self-grinding, but also assisted by added steel balls. So in a way, the drum in your washing machine is also semi-autogenous. Now let's have a look at this project in execution. It is a new mine with a 30-year life and 300,000 ounces of average annual production over the first 5 years, and peak productions here are estimated to be 26 to 30. Open pit mining with standalone mill for processing 3 million ounces of reserves and 1.4 million ounces of measured, indicated and inferred resources. Consists of 7 mineralized areas which remain open pit in all directions along 14-kilometer strike with significant upside potential. The scope is mine development of 4 new open pits, new tailings storage facility, highway diversion, new processing facility. So I think the most important takeaway here is that Newmont expects to get 300,000 of average annual production, and they expect the mine life to be 13 years. So let's get back, and with Ahafo being managed T1 asset, we now know that 5 out of 6 of Newmont's managed T1 assets are located in Africa and Australasia. Let's move on to the next region, North America. North America. This region accounts for 12.5% of Newmont's managed portfolio, while contributing 40% of total attributable gold production, a significant portion of which comes from non-managed operations. Looking at reserves and resources, the region holds 33% of Newmont's total reserves and 23% of its total resources. Now I know that the screen is getting busy, but no worries, we'll walk through it step by step. Let's start with Canada, where Newmont has 5 operations. 3 of these, Musselwhite, Eleanor and Porcupine, are part of Newmont's divestment program and are agreed to be sold. All 3 mines process refractory ore. While their production and reserves are rather moderate, their ore grade and recovery rates are quite strong. Musselwhite has 5.7 grams of gold per ton of ore, with 96% recovery rate. Eleanor has 4.8 grams per ton with 91% recovery rate. And Porcupine has 3 grams per ton with 91% recovery rate. For Musselwhite we have 1570, for Eleanor 1914, and for Porcupine 1422. The sale of Porcupine is expected to be closed in first half of 25, subject to certain conditions being met. Now, given that those mines here are agreed to be sold, let's move on to the 2 core assets Newmont retains in Canada, Red Chris and Brucejack, both located in the Golden Triangle region. Newmont owns 70% of Red Chris, with the remaining 30% held by Imperial Metals Corporation. This joint venture was originally between Newcrest and Imperial Metals, but after acquiring Newcrest in 23, Newmont took over Newcrest's stake. Looking at the grades and recovery rates, Red Chris has relatively low numbers, just 0.3 grams of gold per ton of ore and 54% recovery rate. This is in stark contrast to Brucejack, which has 5.7 grams per ton and 96% respectively. Production at both mines is relatively low compared to T1 assets. Red Chris produced just 24,000 ounces in the first quarter of 24, while Brucejack production was higher at 186,000 ounces, but still well below the T1 levels. All-in sustaining cost at both mines is also relatively high compared to T1 assets. For Red Chris we have 1,882 and for Brucejack 1,642. And this is exactly why these mines don't qualify as T1 assets. A key requirement for T1 status is annual production of over 500,000 gold equivalent ounces and all-in sustaining costs in the lower half of the industry cost curve, which these mines clearly do not meet. One note about the Brucejack: during the earnings call, management highlighted that Brucejack continues to see periods of exceptionally high grade ore, including a one-day average of 52 grams per ton, which is really high. You may also recall that Newmont adjusted its 2025 production guidance for Brucejack, lowering it by 100,000 ounces compared to the initial outlook from February. And this is due to ongoing development work at the Brucejack. Now let's take a look at Newmont's operations in the United States, starting with Cripple Creek and Victor, or CC&V. That was divested, and the reasons are clear: relatively low gold production and high all-in sustaining cost. However, CC&V stands out as one of only 3 Newmont's mines that use leaching as a primary processing method, while the rest rely on milling. In total, 39 million ounce was mined, with 26 million processed using a leaching method. Now moving on to Nevada Gold Mines, NGM, one of Newmont's largest non-managed assets. This is a joint venture with Barrick Gold, where Newmont owns a 38.5% stake and accounts for it using the proportional consolidation method, which is why we see operating statistics here, including the all-in sustaining cost. Because in contrast, Newmont's other non-managed operations, Pueblo Viejo and Fruta del Norte are accounted for using the equity method. This means Newmont only records its share of net earnings without breaking down operational metrics like all-in sustaining cost. That's why we won't see it for Pueblo Viejo and Fruta del Norte. While for Nevada gold mines, Newmont uses proportional consolidation method. NGM has large-scale gold production with 1.17 million attributable ounces in 23 and 759,000 ounces for the first 3 quarters of 24. And this gold production represents Newmont's 38.5% attributable portion. The total production at NGM is significantly higher. Looking at the total ore mined, NGM operates massive open pits, extracting over 100 million tons of ore, the largest volume among Newmont's operations. About half of the ore processed using milling, while the rest goes through leaching. NGM meets the key T1 criteria with large-scale production and a strong reserve base. It has 18.3 million ounces of reserves and 17.4 million ounces of resources. While all-in sustaining cost for the first 3 quarters of 24 was $1,645, its high output and long-term viability keep it in the T1 category. Average grade is 3.5 grams for milling and 0.4 grams for leaching. The average recovery rate is 83%. Another non-managed T1 asset is Pueblo Viejo, located in Dominican Republic. This is also a joint venture with Paragold, where Newmont owns a 40% stake, also accounting for it using the equity method. Attributable gold production was 224 and 173,000 ounces. All-in sustaining cost and cost details are not viable, but with its large-scale production, Pueblo Viejo meets criteria for T1 asset. Last but certainly not least, the 6th managed T1 asset in Newmont's portfolio is Penasquito, located in Mexico. Penasquito is Newmont's largest managed gold equivalent ounces producing asset. Unlike most of other Newmont's mines, Penasquito is polymetallic operation, producing gold, silver, lead and zinc. While its gold production alone is not particularly high, its co-product metals contributing significantly, making it the largest gold equivalent ounces producing asset. And production at 23 was lower due to the labor strike. However, during the most recent earnings call, management stated that a new collective bargaining agreement was signed with the union and Penasquito, ensuring a stable foundation for operations through 2026. All-in sustaining cost per ounce was $1,590 and $1,112. Penasquito is also a large-scale open pit mine and Newmont's second largest operation by total ore mined after Nevada gold mines. In total, 96 million tons of ore were mined, with almost 21 million tons processed through milling at an average rate of 0.43 grams and a 57% recovery rate, which is on the lower side. Total reserves stands at 4.6 million ounces, while total resources amount to 1.5 million ounces. So I know it's a busy screen, but to summarize, North America accounts for 40% of Newmont total attributable gold production and 33% of its reserves. And after divestments, the go-forward portfolio in the region will consist of 2 managed operations in Canada, Red Chris and Brucejack, 2 non-managed T1 assets, 1 in the US Nevada gold mines, and 1 in the Dominican Republic, Pueblo Viejo, and 1 managed T1 asset in Mexico, important one, Penasquito. Finally, moving to the last region, South America. This region accounts for 90% of managed portfolio and 40% of Newmont's total attributable gold production. In terms of reserves and resources, South America holds 9% of total reserves and 7% of total resources. Starting with Marion, a mine located in Suriname, Newmont owns 75% of Marion, with the remaining 25% held by Staatsolie, the state oil company of Suriname. Attributable gold production was 242 and 146,000 ounces, respectively, and all-in sustaining cost per ounce was 1,541 and 1,926, positioning it on the higher end of Newmont's cost curve. In total, 41 million tons of ore were mined, with 40 million tons processed through milling at an average rate of 0.8 8 grams per ton, and 91% recovery rate. Total reserves stands at 3.9 million ounces. Total resources amount to 2.5 million ounces. Moving on to Cerro Negro, Newmont's underground mine in Argentina. Attributable gold production was 269 and 160,000 ounces, and all-in sustaining cost per ounce was 1,509 and 752, positioning it on the higher end of Newmont's cost curve. In total, 1.1 million tons of ore were mined with the same amount processed using milling method at an average grade of 8.3 grams per ton and 93% recovery rate, the highest ore grade among Newmont's managed operations. Total reserves stands at 3.2 million ounces, while total resources amounts to 1.5 million ounces. Next, Yanacocha, Newmont's asset in Peru, that is ranked third among Newmont's operations in terms of total ore mined. In total, 62 million tons of ore mined, with 20 million tons processed through leaching. So it's a third operations to use leaching at an average grade of 0.5 grams per ton. So we have only 2 mines in Newmont's go-forward portfolio that use leaching method, the Nevada gold mines and Yanacocha. The rest are using milling method. Attributable gold production was 276 and 262,000 ounces, and all-in sustaining cost per ounce was 1,262 and 1,207, positioning on the lower end of Newmont's cost curve. Total reserves stands at 5.6 million ounces, while total resources amounts to 8.2 million ounces. And finally, we have third non-managed operations of Newmont, Fruta del Norte mine, located in Ecuador. Here Newmont owns 32% stake and accounts for using equity method. The rest is owned by Lundin Gold, small Canadian gold mine that we already saw previously. There was interesting agreement between Newmont and Lundin before 24 as part of the original project financing for FDN. Lundin had a stream credit facility and offtake agreement with Newmont. These agreements entitled Newmont to a portion of the gold and silver production from FDN at a predetermined prices, serving as a means to finance the mine's development. In 24, Lundin bought out 100% of the remaining balance of the agreement for $330 million, allowing it to fully own the production from the FDN without any ongoing obligations to Newmont. This deal also helped Lundin Gold eliminate its project finance debt and become debt-free. Attributable gold production here was 99,000 ounces for the last 3 quarters of 24. And of course, Newmont doesn't report all-in sustaining costs for FDN since it accounts for its minority interest using the equity method. However, based on Lundin Gold's report, the FDN's all-in sustaining cost for the first 9 months of 24 was just $874 per ounce, making it one of the lowest cost gold mines in the industry. Even more impressive, the FDN has an average ore grade of 10 grams per ton, one of the highest in the industry. So to summarize, South America accounts for 14% of Newmont's total attributable gold production and 9% of its reserves. The portfolio in the region consists of 3 managed operations, so those are Marian, Cerro Negro and Yanacocha, and 1 non-managed operation. This is Fruta del Norte. Now let's zoom out and take a step back to make some concluding remarks. But before we do that, if you look closely, you'll notice that while the gold production breakdown by region adds up to 100%, the totals for reserves and resources do not. Let me show you why. When reporting gold reserves and resources in 10K, Newmont includes mines that are not depicted on this map. So for reserves, the mines marked in red are not shown on the map. They account for 21.8 million ounces of reserves. So if you add that to the reserves shown on our map, which sum to 140 million ounces, it will add up to 100%, which is 135.9 million ounces. And the same is true for resources. The mines in red represents those not disclosed on our map, but they're included in Newmont's total resources count, which accounts for 62 million ounces. So again, if you add what we have in our map and what we have marked in red here, you'll get 100%. So while production figures are mapped fully, some reserves and resources are reported separately, which explains the difference. So looking at Newmont's go-forward portfolio of 11 managed and 3 non-managed operations, I would focus on the T1 assets, and both managed and non-managed, since they account for just under 80% of Newmont's total attributable gold production. The remaining production comes from 2 mines in Canada, Red Chris and Brucejack, and 4 in South America, 3 of which are managed operations. And to prove my point, take a look at this chart. So here we have Newmont's largest gold equivalent ounces producing T1 assets for the last 12 months, and this accounting for Q4 23 through Q3 24, which together account for just under 80% of Newmont's total attributable gold production. And you'll notice that Carlin, Cortez and Turquoise Ridge are all part of Nevada gold mines, which is why on the map earlier, for the Nevada gold mines, the three are grouped under the NGM umbrella. Penasquito stands as Newmont's largest managed T1 asset in terms of gold equivalent ounces production, followed by Cadia and Boddington, along with Lihir and Tanami. This makes up the four managed T1 mines in Australasia that we saw here. Next, Ahafo, the one and only managed T1 asset in Africa, bringing the total count of managed T1 assets to 6, and the two remaining non-managed T1 assets are Pueblo Viejo, where Newmont holds 40% interest, and Fruta del Norte, where it holds 32% of interest. So together, these assets, both managed and non-managed T1 assets, account for 80% of Newmont's total attributable gold production. And I hope this chart provides a clear snapshot of where Newmont's highest volume production is concentrated and why we should pay attention to those managed and non-managed T1 assets. And that concludes our overview of Newmont's global operations. Now that we have a clear picture of Newmont's portfolio, let's move on to the next section, where we'll compare Newmont to its peers and analyze how it stacks up against other gold mining companies. Okay, gold miners peer analysis. We will compare the financial, operational and some very basic valuation metrics of 5 gold miners: Newmont, Agnico Eagle, Barrick Gold, Kinross and Lundin Gold. We assess key indicators including production, cost efficiency, profitability, capital efficiency, leverage and valuations. I won't go through each item line by line, but if you want to dive deeper, feel free to pause the video. Starting with attributable gold production, Newmont and Barrick dominate production, with Newmont reaching 5.5 million ounces in 2023, followed by Barrick at 4 million ounces, followed by Agnico Eagle at 3.4 million ounces, Kinross at 2.2 million ounces, and Lundin Gold at 481,000 ounces. We can see that Newmont also leads in production for the third quarter of 24 at 1.7 million ounces, followed by Barrick, Agnico Eagle, Kinross and Lundin being the smallest gold miner among the 5, produced 122,000 ounces in Q3 2024. Production trends vary. Newmont shows significant year-over-year growth and had largest growth in production in Q4 23. Do you know why? It's because of Newcrest acquisition that was finalized at the end of the third quarter of 23. So Newmont had jump in production, followed by its somewhat lower production in Q1 and Q2 of 24 and 3.8% production growth in Q3. Barrick had relatively stable production throughout 2023, but had negative growth of 11% in Q1 24 and flat growth thereafter. Kinross had a good growth of 11% in third quarter of 24, and Lundin had negative quarter-over-quarter growth throughout 2023. But take a look at 24. 12% growth in Q1, 90% in Q2, then you get someone lower growth of negative 8% in Q3. But if we look at the year-over-year growth, we can see that Lundin finishes with almost 9% year-over-year growth in third quarter of 24. And also, to be honest, the production at Lundin is quite small. Going from 133,000 ounces to 122,000 ounces. In percentage terms, that seems a lot, but in absolute terms, it is small decrease. Moving on to all-in sustaining cost per ounce with trends. Newmont and Barrick report the highest cost, both exceeding $1,500 per ounce in Q3 24, and you can see for Newmont the all-in sustaining cost for third quarter of 24 is higher than for the financial year of 23. Same for Barrick, 1,507 versus 1,336, suggesting some cost inflation. Lundin Gold remains the most cost-efficient producer, with all-in sustaining cost of only $877 per ounce. And we can see that excluding fourth quarter of 23, the all-in sustaining costs were relatively flat in absolute terms. Agnico Eagle and Kinross maintain mid-range costs ranging from $1,200 to $1,300 per ounce. Now let's take a look at the changes in all-in sustaining cost per ounce quarter over quarter. Newmont's all-in sustaining cost has been volatile, rising 7% initially, dropping to negative 3%, then climbing again at 4%, then declining again with 4%, with a notable 8.5% spike in Q2 before settling at 3% in Q3 24. Agnico saw steady increase throughout 2023, some cost improvements in the first half of 24 before settling at 10% in Q3 24, suggesting cost pressures later in the period. Barrick had a cost spike of 8.7% in Q4 23, followed by 8% increase in Q1 24, and managing to control costs thereafter at 1.6 at 0 and 0.6%. Kinross maintained relatively stable costs with minor fluctuations and a final 1.8% decline. Lundin Gold saw the significant cost increase throughout 2023, with all-in sustaining costs rising 10%, 13% and 17%, though it later corrected with a 80.3% drop and well-controlled costs thereafter. And if we look at the year-over-year trend, we can see that costs have generally increased across the board, reflecting inflationary pressure and raising operational expenses. But if we look at absolute all-in sustaining cost per ounce, we can make an argument that cost escalation is biggest for large gold miners, namely Newmont and Barrick. Moving on to profitability metric, we can see that Lundin Gold leads with adjusted EBITDA margin of 68% in Q3 24. Agnico Eagle, Barrick and Kinross show solid margin above 50%. Newmont lags behind with EBITDA margin below 43%. That are improving compared to 2023, but still lower versus peers. Net income margin. Lundin Gold remains the most profitable company with 42% net income margin. Agnico Eagle and Kinross maintain strong net income margin of 26 and 25% respectively. Barrick has the lowest net income margin that was relatively stable throughout 23 and 24, and Newmont exhibits the highest volatility with a net income margin fluctuating from negative 79% to positive 20%. But negative net income margin in Q4 24 was driven by net loss due to substantial impairment and reclamation charges. 1.9 billion in impairment charges, 1.5 billion in reclamation charges, and $500 million in Newcrest transaction and integration costs. These 1.9 billion of impairment charges was due to the write-down of goodwill of 1.2 billion at Penasquito, 300 million at Musselwhite, and 250 million at Eleanor. So it was one-time event, and if we look at adjusted net income and adjusted net income margin for Newmont, we'll see that it's stable and increasing from 9% to 12% to 15% and to finishing at 20.3%. And looking at adjusted net income margin for the rest of the peers, the trend remains largely the same, with a small exception. Kinross and Lundin saw somewhat better adjusted net income margin for Q4 23 compared to their unadjusted figures. Next, free cash flow margin. Lundin Gold leads in free cash flow generation with 56.2% free cash flow margin. Kinross and Agnico maintain healthy free cash flow margins of just under 30%. Barrick and Newmont show weaker margins, 13% and 6.5% respectively, reflecting both higher CapEx and cost pressures. And once again, Newmont's weak free cash flow margin in 2023 was driven by unfavorable working capital charges, 530 million and 2.7 billion in sustaining capital investments. However, since then, free cash flow showed improvements, as can be seen in expanding free cash flow margin, especially in the last 2 quarters of 24. Moving on to free cash flow to CapEx ratio, Lundin Gold has the strongest free cash flow coverage of CapEx, 650%. And I had to double check that figure. This comes from combination of high free cash flow and low CapEx, which isn't always a positive if low CapEx means delaying necessary investments for future growth, but in Lundin case that doesn't seem to be the case at the moment. Kinross and Agnico Eagle follow with coverage of 149% and 128% respectively. Barrick and Newmont are lagging with 60% and 87% respectively. We can see that the number for Q4 23 is disturbed due to the negative free cash flow. Moving on to leverage, looking at debt to EBITDA, Newmont has the highest leverage of 1.5, followed by Barrick at 1 and Kinross at 0.9. Agnico Eagle maintain low leverage of 0.4, while Lundin Gold operates at zero debt. Remember when we've looked at our map at Fruta del Norte mine in Ecuador to be specific, we've discussed Lundin's stream credit facility and offtake agreement with Newmont, and that after Lundin bought out 100% of the remaining balance of this agreement, it became effectively debt-free. Okay, now let's have a look at the valuation metrics. Newmont offered the highest dividend yield in 2023 at 3.9%, followed closely by Lundin and Agnico Barrick at 3.2% and 2.9%. Barrick and Kinross maintained stable but lower yields of around 2%. However, we can see that Newmont's dividend yield has declined, dropping to 1.9% in 24. If in 23 the dividend per share was 40 cents per quarter, it has now been reduced to 25 cents per share in 24. For the third quarter of 24, Lundin offers the best dividend yield of 3.7%, while Kinross offers the lowest yield of 1.3%, followed by Newmont, Agnico and Barrick. Now let's take a look at PE ratios. I'm using the trailing 12-month diluted PE, which is backward-looking, not forward-looking, but for a high-level P comparison, it works well. Looking at the data, we can see that larger gold miners like Newmont and Barrick and Agnico Eagle had the higher PE ratios through 2023, while the valuations moderated in 24, but not for Agnico. Take Newmont, for example. Its PE was higher at the end of 2023, starting at 26.3, but contracted in 24, ranging from 20 to 21. This isn't surprising, as gold prices rose, driving higher sales. The stock price of Newmont remained relatively flat, likely reflecting margin pressure from rising costs. Meanwhile, smaller miners like Kinross and Lundin were consistently at the lower end of PE range throughout 2023, though their valuations expanded into 24. Even in Q3 24, Kinross and Lundin still had lowest PE ratios at 50.7 and 16 respectively, followed by Barrick, Newmont and Agnico. Now let's take a look at year-to-date 12-month trailing PE, since I'm recording this on February 5th and Q4 24 results aren't out yet. They are set for release on February 20th. I have to approximate. To do that, I take the stock price on February 5th and divide it by the last available 12 month of EPS, which includes earnings from Q4 23 to Q3 24. This approach isn't perfect. It doesn't capture the latest earnings, while the stock price already reflects expectations for Q4 and beyond, including factors like higher gold prices, but it still serves as a quick valuation check before new earnings are released. And of course, Lundin is the only gold miner among the peers that is traded on the Toronto Stock Exchange. So while the financial metrics was expressed in US dollars, the stock price was expressed in Canadian dollars. So I had to use the exchange rate to convert prices from Canadian dollars to US dollars. Looking at the data, Barrick, that had one of the lowest PE ratio, remained flat at 16, likely reflecting ongoing operational and cost inflation challenges. Newmont, on the other hand, sees further multiple compression, dropping from 21 to 17.7. But what's interesting is that Kinross and Lundin both showing PE expansion, moving from 50.7 to 19.9 for Kinross and 16 to 20.5 for Lundin. When we later dive into return analysis, we'll see that these two, along with Agnico Eagle, delivered the best returns. And for Lundin, this high valuation might be justified considering the growth potential at Fruta del Norte, but we'll get into that later. Moving on to reserves and resources valuation, and let me unhide something here. I have here the reserves and resources with a breakdown to proven, probable, and proven and probable, and they break down between two. And same goes for resources, have measured, indicated, and inferred. And they have a enterprise value here as of 30th of September 24. And we're going to divide enterprise value to reserves to see how each ounce of gold reserves and resources are valued based on the enterprise value. Let's start with Newmont, as being largest gold miner, hold the largest reserves of 136 million ounces. These are proven and probable reserves, followed by Barrick at 76 million ounces, Agnico at 53.8, Kinross at 23, and of course Lundin has the smallest gold reserves of 5.5 million ounces. Here I have a breakdown of percentage of reserves being proven. You can see that for Newmont, only 17% of reserves are proven, the rest are probable. And similar picture is for Agnico, somewhat better for Barrick, 20 proven, 80% probable. Even better for Kinross, 30% proven, 70 probable. And look at Lundin, 42% of its reserves are proven, the highest ratio among 5 peers. Let's take a look at enterprise value to reserves ratio, which shows how much each ounce of gold in the company's reserves is valued relative to its enterprise value. And enterprise value is recorded as of the end of September 2024. This metric here for Newmont, for example, suggests that each ounce of proven and probable reserves is valued at $499 per ounce. The lowest, those most attractive among peers, followed by Kinross and Barrick. For comparison, as of February 5th, gold is trading at $28.50 per ounce. So we can see gold reserves are valued at a discount, which of course must be the case. At the other end, Lundin has the highest, thus least attractive ratio at $903 per ounce. But here is what stands out. Lundin and Kinross have the lowest ratio of enterprise value to proven reserves, yet Lundin's overall enterprise value to proven and probable is the highest. And this is mainly due to the lower probable reserves. My thinking is that Fruta del Norte is still relatively new mine, and while it has high-grade gold underground, some of it has yet to be classified as reserves. Lundin has developed key areas, but there is still a lot of potential ore underground that hasn't been fully explored or formally classified. For enterprise value to resources, looking at measured and indicated, Barrick and Kinross have the lowest ratios, followed by Newmont and Lundin and Agnico. And here we go, Lundin has the lowest ratio for measured resources, meaning there is large portion of measured resources, and for Lundin, measured resources represent 42% of measured and indicated. Again, the highest among the peers, meaning that under certain conditions, these resources can eventually be upgraded to probable reserves, potentially lowering EV to probable and those EV to proven and probable reserves over time. That's why I'm not that much concerned about high ratio here. Again, it's because the Lundin has high proportion of proven reserves and high proportion of measured resources compared to peers. So we can see that Newmont and Barrick lead in scale, both when look at the reserves and gold production, but struggles with raising costs and somewhat squeezing margins. Lundin Gold stands out with low costs, high profitability, low leverage, and high dividend yield, making it attractive at a relatively moderate PE. Same, but to the lesser extent, can be said about Kinross and Agnico. And given relatively high production level at Agnico, it controls cost nicely, though PE ratio is on the high end. However, Newmont and Barrick remain key players in scale, despite cost pressures. And I think the comment made by Newmont's management applies to both Newmont and Barrick, which is that focus must be made on expanding margins, generating strong return on capital, and creating value versus chasing volume. But if I would have to choose a winner among these 5 peers, that would be Lundin. I like low cost and efficiency they have at running their single Fruta del Norte operations. I like how healthy their margins look. I like how much cash they generate. I like their proportion of proven to probable reserves. And I'm okay with moderate PE and paying a bit more for their potential growth. I think in that case, words of Charlie Munger could be applied, that it is better to buy good business at fair price than fair business at good price. Okay, let's finish this section with return analysis. Let's start by looking at the total return performance for these 5 gold miners. At the bottom of the table, I've also included the annual performance for gold spot as a benchmark, and since direct gold exposure is typically obtained through futures, I've added the UBS Total Return Gold Index, which accounts for the cost of rolling futures contracts. This gives us a more accurate picture of the real return an investor would receive from gold futures. Looking at the 5-year cumulative performance, Lundin has been the clear outperformer, delivering a massive 268% price return since 2020 and a total return of 305%, including dividends. This stands in stark contrast to the 2 largest gold miners, Newmont and Barrick, both of which have underperformed. Newmont is down 40% in price return over 5 years, but flat in total return, while Barrick has fallen 70% in price and 5.5% in total return over the same period. Meanwhile, gold spot gained 73% over 5 years, with cumulative gold return sitting at 68% when accounting for roll yield. Gold miners are generally leveraged to gold prices, meaning they tend to outperform in bull markets and underperform in bear markets, a result of operational leverage. We see this clearly in 2020 and 2021, when gold rallied in 2020, miners surged even higher, and while gold declined in 2021, miners dropped even further. But this pattern doesn't always hold, not for every company. For example, Newmont outperformed in 2021, and also in 2024, gold surged 27%, yet Newmont and Barrick struggled. But it certainly held for Agnico, Kinross and Lundin, that skyrocketed in 2024. So in 2024, if you had to choose between Newmont or simple gold futures position, you would have done better with futures. But you would have to done even better had you chosen Kinross, Lundin or even Agnico. And of course Barrick did the worst in 2024, negative 12.3%. Looking at individual names, Newmont delivered positive returns in 20 and 21, but had negative returns thereafter. Agnico took a big hit in 2021, but rebounded well thereafter, especially in 2024, delivering 46%. Yet on the 5-year cumulative basis, it still lags gold futures, delivering only 27% return compared to 68% return for gold futures. Barrick had positive return in 2020 and 23, but negative return 21, 22 and 24. Again, worst performance among peers for Barrick in 24. Kinross delivered a very good return in 20, suffered heavily in 21 and 22, but what a comeback thereafter. 52% in 23 and 56% in 24, leading to a cumulative price return of 96% and 115% total return over 5-year periods. And then there is Lundin, the clear frontrunner, just one negative return in 21, but still outperforming most of the peers, followed by massive return thereafter. In 2024 alone, it delivered 91.5% price return, pushing its total cumulative price return to 268% and total return to 305%. Seems like small scale and operational efficiency really paid off here. And this performance breakdown here shows that while gold miners are leveraged to gold, a bull market in gold is not a silver bullet, as can be seen in 24 for Newmont and Barrick. Company-specific factors such as cost control and operational efficiency play a crucial role, as we can see for Newmont and Barrick. Now let's talk about the seasonality trends, as gold miners can follow recurring patterns throughout the year. And once again, I've included gold's performance for comparison. Here is a spot and here is the total return index. What we see is that miners generally struggle in February, June, August and September. We have here Newmont, Agnico, Barrick, Kinross and to less extent Lundin, which align at least to some extent with seasonal weakness in gold. Meanwhile, March, April, July, and to some extent October tends to be stronger month, again mirroring gold's performance. There is some anecdotal evidence of gold seasonality being related to jewelry demand and portfolio rebalancing. March to May might be driven by drilling demand, particularly in India and China, and portfolio rebalancing, where institutions allocate more to gold at the start of the year and then post-January dip in February when rebalancing fades and speculative positions unwind. But again, these are not consistent every year and are rather anecdotal. And as we've seen recently, volatility and macroeconomic uncertainty have a much bigger impact on gold performance than seasonality. Now take a look at January 25. Gold price increased 6.6% and exceptionally strong performance across the board. Newmont gained 15%, Agnico Eagle 20%, Barrick 6.6%, Kinross 22%, and Lundin 17.4%. All while US dollar is becoming stronger. That's again an example of operating leverage at play, where miners amplify gold's movements. So I think we can conclude that looking at the last 5 years, and especially the recent couple of years, I think we can agree that smaller miners have outperformed both gold and the larger peers. Among them, Lundin has delivered particularly strong returns, all while trading at relatively low valuation metrics like PE, as saw previously. In hindsight, that combination of attractive valuations and strong performance made it an excellent investment opportunity. Alright, let's do a walkthrough of some financial documents of Newmont. We'll be looking at two: the press release and earnings call transcript, both for third quarter of 2024. And I've highlighted some important things here, and I will add both documents as PDF attachment. But by now you already know the key themes at Newmont, so instead of reading everything highlighted out loud, I'll add parts of our slides that we've already discussed on the left third of the screen. This makes it quicker and cleaner to follow, since you'll be able to connect and map what's being said in the release and transcript to what we've already covered. I think it also keeps things more engaging and helps you remember the important points better. So let's get into it, and let me show you how I think you can use it. Let's start with the first sentence. In the third quarter, Newmont delivered 2.1 million gold equivalent ounces and generated 760 million in free cash flow. And if we look here, we know that the attributable gold production was 1.7 million ounces. Co-product production was 430,000 ounces, which together makes it 2.1 million gold equivalent ounces. And free cash flow, we see here, free cash flow 760 million. And you can really do the same for every single highlighted bullet or sentence. Let's take the first bullet, for example. Under the third quarter results, Newmont announced agreement to sell a Cadia mine in Ghana for 1 billion and Telfer in Australia for 475 million. And if we scroll here, we see here sale of a Cadia for 1 billion and sale of Telfer for 475 million. And of course we know that by now all of Newmont's 6 non-core assets were agreed to sell. Take a second point, for example, receive at least 2 billion in gross divested proceeds from high-quality non-core assets. We know that they had meaningful progress, non-core divestment program on track to generate 2 billion in gross proceeds by 2024. Authorized additional 2 billion shares repurchase program. We know that they authorized additional 2 billion shares repurchase program. So again, all those points were discussed already, and they are all in the first slide that we've covered, so I won't go through it, and you have also some granularity on this. For example, achieve 500 million in annual synergy rate, we know that, and we even know the breakdown where the synergy were achieved. So you can walk this through by yourself. Instead of me going through every single screen, let me just focus on the important points that I think where comments would be useful. This is a summary of third quarter results, and we also saw it in our Excel when we were discussing the EP analysis. 2 points here. You can see that the average realized gold price increased year over year and quarter over quarter. And I've added the comment here that gold average realized price increased by $598 per ounce to $25.18 from $90.20. So looking at the third quarter year over year. And the sensitivity analysis on presentations says that $100 increase in gold price leads to 675 increase in sales. Therefore, sales are expected to increase by around 4 billion. And if you're wondering where I'm taking those numbers, it is in the third quarter presentation, and I believe it's page number 16. Yeah, here we go. So there's pricing assumptions and sensitivities. You see gold here, that's the assumption, which was done as of February 2024. And you can see that $100 change should lead to 675 increase in total revenue. And here you have Canadian dollar, for example. The assumption is 0.75 Canadian per US dollar, and I think the average for the third quarter was around 0.73. Oil assumption was 90. The average for third quarter was 78. And here other assumptions: copper, silver, lead, and zinc. So if you're wondering where I take those numbers, you know it now. So keep this in mind. The sales are expected to increase by 4 billion year over year, and we'll see in a moment if that's the case. The second comment is gold all-in sustaining cost per ounce. We can see that it was increasing as we saw on our screen, and we'll look in a moment for the breakdown of cost increase. Let's deal with those sales first. If I scroll to the consolidated statement of operations, we can see that sales for third quarter were 4.6 billion, and for third quarter of 23 was 2.5 billion. So only 2.1 billion of revenue increase was realized instead of 4 billion. And again, we discussed earlier why this can be the case. It's just the price assumption model. This is going to be the new one. Attributable gold production increased 4%. Well, we know that. But what is new is this, primarily due to higher production at Cerro Negro, following completion of investigation into the tragic fatalities of 2 members of Newmont workforce in the second quarter. Third quarter production also benefited from higher throughput at Brucejack. We know this is mine in Canada. High mill utilization at Ahafo mine in Ghana in Africa. And improved production at Yanacocha, primarily driven by the benefits of injection leaching. And if you're wondering what this injection leaching is, it is a mining process where a leaching solution like cyanide is injected directly into the ore body. So we know that with the heap leaching, the solution is sprinkled to the ore stockpile. Well, here solution is pumped into the ore through injection wells or drill system, and then the metal-rich solution, so what we call protein solution, is then collected through recovery wells or drains. Sometimes it's more efficient process, which was the case at Yanacocha. And by now we know where each operation is located. We have Cerro Negro here in Australia, so we have high production at Cerro Negro. We have a higher throughput at Brucejack, which already has very, very high gold yield. We have higher utilization at Ahafo and higher gold yield at Yanacocha due to this injection leaching. Remember, Yanacocha is one of 2 Newmont's go-forward portfolio that is using leaching method. The rest are using milling method. Average realized gold price was $25.18, an increase of $171 per ounce. So which means that quarter over quarter we would expect 1.1 billion increase in revenues from the higher gold prices. Let's look at the cost applicable to sales. Per ounce increased 5%, primarily due to higher direct cost at Lihir as a result of plant autoclave maintenance. What do we know about the autoclave process? We know it is used to oxidize gold-bearing sulfide, and sulfides can be found in refractory ore. So we know that at Lihir there was plant autoclave maintenance. We can say that Lihir mines refractory ore. As well as higher direct operating costs, primarily due to increased contract services. And we know that the contract service at Newmont represent 15 to 20% of cost structure. Let's look at the cost applicable to sales per gold equivalent ounce. And if we scroll down to the operating statistics, to the all-in sustaining cost per ounce, we can see here co-product all-in sustaining cost per ounce. And we have 4 mines for which we account for that. Remember, those 4 mines, Boddington, Cadia, Penasquito and Red Chris, they mine other metals along the gold. Look at here, we have in gray the co-product gold equivalent ounces production. So we see that the Boddington has co-product Cadia, Red Chris and Penasquito. And for Penasquito, the co-product represent the largest proportion of total co-product gold equivalent ounces production. And remember, the co-products all sustaining cost does not use co-product sales as credits, as is the case for byproduct method. So co-product allocates a portion of total site cost to each metal based on relative revenue or production, and then divided by the total gold equivalent ounces. And you will expect co-product all-in sustaining cost per ounce to be higher than gold all-in sustaining cost, because co-product may require extra processing, labor or complexity, which increase the overall cost base. And if co-products are costly to produce but contributes little to gold equivalent ounces, this pushes co-product all-in sustaining cost high because you have lower denominator with lower gold equivalent ounces production. However, if co-products generate significant revenue and high gold equivalent ounces, for example let's take copper, during the high price periods, then the cost per gold equivalent ounce may decrease due to the larger denominator. So if you have larger gold equivalent ounces production, your all-in sustaining cost per ounce decreases. Let's take Penasquito for example. We know that core product represents the largest portion of its gold equivalent ounces. For the third quarter of 24, its all-in sustaining cost per ounce was 1224. And now have a look at core product all-in sustaining cost for Penasquito. It's 1286. So very small increase here. And again, that can be due to the high core product production at a high core product price. And you can even see that for Boddington mine in Australia, all-in sustaining cost per ounce was 1398, while core product gold equivalent ounce was lower, 1168. So yeah, my point is that depending on the production volume of gold equivalent ounces and the metal price, the core product all-in sustaining cost per gold equivalent ounce can be either higher or lower than gold all-in sustaining cost per ounce. Okay, let's get back. We have here net income attributable to Newmont's stockholder, 922 million, we know that. And adjusted net income was $936 million. And the biggest part of the adjustment, a loss on asset held for sale of 150 million. Consolidated cash from operations before working capital increased 11% from the prior quarter to 1.8 billion due to higher realized gold prices. So here we see the positive effects of the higher average realized gold prices. Free cash flow increased 28% due to improvements in cash from operating activities, including reduced working capital impacts, partially offset by high capital expenditures. And we know that the capital expenditures, especially sustaining CapEx, is the big drag on Newmont's all-in sustaining costs. And here we see capital expenditures increased 10% to 877 million, so 10% increase. And sustaining capital spent increased due to timing of projects at Ahafo, Tanami, Boddington and Lihir. Development capital expenditures in 24 primarily relate to Tanami Expansion 2, Ahafo North and Cadia Panel Caves. And remember, those three are what Newmont's refer to as three projects in execution, along with Cerro Negro, which is the fourth project in execution. And we saw it on our map. We had in orange projects in execution. We have Cadia, Tanami Expansion, Ahafo North, and here is Cerro Negro District Expansion. Balance sheet and liquidity, we haven't discussed that, but cash balance at the end of third quarter was 3 billion, and net debt to adjusted EBITDA was 0.9. Let's look at non-managed joint ventures and equity method investments. Nevada Gold Mines, this is mine in the USA. Attributable gold production decreased 4% to 242,000 ounces, with a 7% increase in cost applicable to sales, which is double effect, right? You have decrease in production and increase in cost applicable to sales. If you remember when we discussed the all-in sustaining cost per ounce here, we said that the biggest contributor to all-in sustaining cost per ounce are gold production, because it acts as denominator, cost applicable to sales and sustaining capital. So what Newmont here is saying is that at Nevada Gold Mines, they had lower production and higher cost applicable to sales, which you would expect should lead to increase in all-in sustaining cost per ounce. But here Newmont says that all-in sustaining cost was largely in line with the prior quarter at 1,675 per ounce. Pueblo Viejo, attributable gold production increased 25% to 66,000 ounces, and Fruta del Norte, attributable gold production is reported on the quarter lag and increased 23% to 43,000 ounces. And by now you should know why Newmont reports sustaining costs for Nevada Gold Mines, but not for Pueblo Viejo and Fruta del Norte. Because remember, in Nevada Gold Mines, Newmont used partial consolidation method, while at Pueblo Viejo and Fruta del Norte, Newmont uses equity method. So there is no consolidation there. And to remind ourselves, here is Nevada Gold Mines in the USA, here is Pueblo Viejo mine in Dominican Republic, and here is Fruta del Norte mine in Ecuador. Oh, one more thing here, when we discuss the capital expenditures here, here's the footnote. Capital expenditure refers to addition to property, plant and mine development from the consolidated statement of cash flow. Here is project updates, and it's focusing here on the Cadia panel case. I won't go through it because we discussed it already previously. I just want to say that there is panel cave 1, 2 and 2, 3, and we discussed it here already. So important things here is that the cave 2, 3 to produce 1 million ounce of gold over 10-year cave life, and cave 1, 2 produce 4 million ounce of gold over 15-year cave life. So it's exactly what is said here. And with regards to Cadia, Newmont currently focus is on maximizing existing tailings capacity, repairing the southern wall of Northern Tailing Facility, and delivering the southern tailing lift. So again, this Northern Tailings Facility, we saw it here, this part of the wall that collapsed. And here we have the Newmont's fourth quarter outlook. Again, nothing new here. We know the attributable gold production for fourth quarter is expected to be at 1.8 billion. All-in sustaining cost at 1475. However, on the earnings call Q&A, we'll see that going forward, the all-in sustaining cost per ounce are expected to be higher. Sustaining capital and developing capital, we saw it already at 550 for sustaining and 320 million for developed, 550 and 320. It is lower for development capital, but higher for sustaining capital. And we discussed why. The sustaining capital will focus on Cadia Tailings Facility, which may result in annual spend of 1.8 billion over a few years from core portfolio. And on the consolidated expenses, we see that exploration and advanced projects are expected to be at 150 million and general and administrative at 110 million. It is higher to what was given back in February for the fourth quarter of 24. The advanced project were at 90 million and general and administrative at 85 million. So again, higher cost there, which will be a drag on all-in sustaining cost per ounce. Here we have operating results. Again, nothing new here. Attributable gold production, cost applicable to sales, and all-in sustaining cost we all discussed on this map. So again, let's take Boddington for example. And we know on our map here, we had statistics for the financial year of 23 and year to date for 24. So let's take Boddington for example. Gold production for 23, 745,000 ounces, 745, and year to date for 26, 426. And the same is true for cost applicable to sales. We didn't discuss it on the map, but the statistics is there in orange. And all-in sustaining cost, again, Boddington financial year 1067, and 1289 for first 3 quarters of 24, 1289. So in case you're wondering where I took these statistics from, well, it's from the press release. One inconsistency I've noticed is that for 11 managed operations, Newmont referred to it as managed T1 portfolio, which is not the same as managed T1 operations, because we know there are only 6 T1 mines here. Boddington, Cadia, Tanami, Lihir, Ahafo, and Penasquito. The rest are not T1 assets, but here they use the word T1 for all of its 11 operations, which is a bit confusing. Anyways, we have here non-core assets, and here are the comments. As of now, all of its 6 non-core assets are agreed for sale. And one more thing I want to say about the all-in sustaining cost. If we compare all-in sustaining cost for managed portfolio with non-core assets, we'll see that for the managed portfolio, the average is $1,500 per ounce. But look at non-core assets, the average is almost 2,000. So here is the consolidated statement of operations. Again, sales, we looked at sales already. We said previously that average realized gold price increased $171 per ounce, which means that we would expect around 1.1 billion increase in revenue quarter over quarter. We can see here that only 200 million were realized. So there is something going on with operating leverage here. Those statistics, net income and earnings per share, we have it already here, so I won't go through it. Asset held for sales, we see that as of September 24, assets held for sale represent 5.5 billion. If we have a look here, the total amount of cash proceeds from the sale of 6 non-core assets at these prices is estimated to be 3.8 billion. So given that the book value of assets held for sale is 5.5 billion, we can expect that Newmont will recognize a loss on the sale. Okay, 5.5 billion book value versus 3.8 billion total announced sale price. Net cash provided by operating activities, 1,648. We have it here, 15% increase quarter over quarter. And here's addition to property, plant and mine development, which Newmont uses as a proxy for CapEx. We have here CapEx of 877. Here are the adjustments for net income to get to adjusted net income. We said that the biggest item is the loss on assets held for sale. And we said that we are likely to see loss on assets held for sale again. And here are the calculations for the free cash flow. So we have net cash provided by operating activities, neglecting the discontinued operations, additions to property, plant and mine development, which Newmont proxy as a CapEx, to get free cash flow of 760 million here. And I think we're getting to the end. Debt amount is 8.5 billion and net debt is almost 6 billion when we deduct the cash and cash equivalents. And one more thing here. So all-in sustaining costs, this is for the 3-month end of September 30. You can see that assets held for sale represents around 20% of cost applicable to sales. And if you look at the sustaining capital, those 6 non-core assets represent 25% of sustaining capital. So we know that it really makes sense for Newmont to divest those assets, because when they do so, they are going to decrease the cost applicable to sales and sustaining capital. Of course, they're also going to decrease the total production, so the denominator will decrease, but the idea is that the decrease from the sale of non-core assets, so the numerator, will drop more than denominator, than the production, which will lead to the lower all-in sustaining costs per ounce. So just want to say that it really makes sense for Newmont to divest those 6 non-core assets, given how much of cost applicable to sales and sustaining capital they represent. And I think we get into the end here. Net debt to adjusted EBITDA is 0.9. That's it for press release. Now let's have a look at earnings call. And I think earnings call with some questions is going to be interesting. Okay, let's do a walkthrough of Newmont's earnings transcript. And management discussion sections, I'll skip it altogether because, again, that's all the information that we saw previously, both in press release and on our presentation. So it's all the same information here. And I'll start with the discussion of operations. And you know what? I just closed this part of the screen because we don't need it anymore. So let me just expand it here. Here we go. So here is the Chief Operating Officer. And again, when she talks about the enhancing long-term productivity at 11 managed T1 operations. Again, it's technically not T1, it's just 11 managed operations. There are 6 T1 operations. So again, it's a bit confusing. I'll start with, here we go, by the way. Driven by our 6 managed T1 operations. So there are just 6 of them, not 11. So starting with Tanami, they began accessing higher grade from the Liberator ore body, remain on track to deliver strongest grade in the 4th quarter. At Boddington, we continue stripping the north and south pits, which is expected to continue through 2025, and will bring forward strong gold and copper grades starting in 26. So both mine allocated in Australia, Tanami and Boddington. Moving to Penasquito, mine in Mexico, we delivered steady gold, silver, lead and zinc production. Remember, in Penasquito, the largest portion of gold equivalent ounces production is co-product. Here we go, Penasquito, co-product. So delivered steady co-product production, well ahead of plan due to efficient stripping. And stripping referred to the removing a large amount of waste rock to access the future gold-bearing ore. So that's what stripping means. This will result in an increase in gold production in the 4th quarter into 25, and Newmont has signed a new collective bargaining agreement with the union at Penasquito. We know there was a strike in Penasquito, which led to lower production in 2nd quarter of 2024, and this agreement is signed through 2026. Cadia, this is mine in Australia and Lihir, so both in Australia or Australasia, Cadia and Lihir. As factored in our guidance, grades at Cadia are expected to continue declining in the 4th quarter as we transition to and ramp up Panel Cave 2-3. They are now setting up Cadia for the next 3 decades of ore feed. Our focus for tailings is maximizing capacity in the current in-pit storage facility, repairing the southern wall of the northern facility that slumped in 2018, we saw that, and raising the wall on the southern facility. These efforts expect to contribute to a period of increased sustaining capital spent at Cadia over the next few years. And we saw that Newmont expects 1.8 billion of capital spent annually, mainly due to repairing the southern wall that slumped. Here we continue to progress the planned shutdown of the primary autoclave, which is expected to deliver approximately 50% step up in gold production in the 4th quarter. And as we look ahead to 25, operational focus at Lihir will remain on reducing complexity to deliver more sustainable and predictable results at this T1 operation. In the short term, this effort will result in lower than initially anticipated production next year. And Newmont says that while we complete this work, we will process a higher portion of lower grade stockpiles in 2025. Thus, the gold production next year from the here is expected to be 250,000 ounces lower than initial guidance for 25 provided back in February. So again, we're talking about this mine in Papua New Guinea, the here. Similarly at Brucejack, we have taken a step back this year to do the development and drilling work to ensure that we improve our knowledge of this nudity ore body. We continue to experience periods of exceptional high grades, including a one-day average of 52 grams per ton, an average of over 20 grams per ton in the same week. This is enormous gold yield. If you look at Brucejack, which has one of the highest ore grades, it has 5.7 grams of gold per ton of ore. Now they're talking that they get 52 grams of gold per ton in one day and 20 grams average gold yield over a week. This is an enormous amount. If you look at Boddington, it has only 0.75 grams per ton. So that's very high gold yield there. However, as a result of the work we are doing, we anticipate that the gold production next year from Brucejack will also be largely consistent with this year, or around 100,000 ounces lower than our initial guidance for 25, again provided back in February. So we know that the gold production will be at least 350,000 ounces lower in 2025 compared to guidance provided in February due to lower production at Lihir and lower production at Brucejack. Moving to Ahafo South. Ahafo is a mine in Africa, the only mine in Africa. In the third quarter, we achieved significant increase in gold production of nearly 15% of the second quarter, driven by high mill throughput following the successful gear replacement and strong grades from Subika open pit and Angro underground mines. We expect Ahafo to maintain consistent production levels in the fourth quarter and into next year before declining in the second half of 2025. And finally, during the fourth quarter, we expect to commence mining activity at Ahafo North and will stockpile ore to be used to commission the mill next year. And I've highlighted two terms here. Commence mining activity means starting the process of extracting ore, and to commission the mill the next year involves starting mill up and testing with stockpiled ore to ensure all equipment functions correctly based on actual ore processing before beginning full production. And it is pre-processing. Sorry about that. So continuing with Ahafo North, we have made notable shift from land clearing and earthwork to constructing the infrastructure for this new mine. Moving on to Tanami, again, this is mine in Australia, and we have here Tanami expansion project in execution. Focus remains on the concrete leading of the shaft. We saw it here in the project in execution, and they are producing 1/2D production shaft, and here is the photo of the shaft. With regards to Cadia Panel Caves expansion, the project is progressing well. At Panel Cave 2-3, we have achieved cave establishment, and this is the initial phase where the underground ore body is intentionally fractured and weakened, meaning that the intended fracturing has begun and gravity is now playing an important role. And again, the side note here, the gravity naturally pulls the broken ore downwards towards drawn point where it can be collected. Over the next decade, Caves 2-3 is expected to deliver 1 million ounces of gold and more than 400,000 tons of copper. And again, we saw it all here when discussed the Panel Cave 2, 3 and 1-2. And again, those Panel Cave 2-3 and 1-2 are located here. So those two are in development, 1-2 and 2-3. Here is Chief Financial Officer speaking. He cited the adjusted EBIT of 2 billion driven by sustained gold prices and strong quarterly production. Comment about the cash flow includes 209 million of unfavorable working capital changes due to built-in stockpiles of 202 million, mainly at Lihir and Telfer, and 107 million of reclamation spent primarily related to the construction of the Nakocha water treatment facility. And Newmont anticipates approximately 225 million to be spent next quarter. Looking ahead, we expect to reach the year's strongest production volumes in the fourth quarter, positioning us to deliver strong free cash flow and continue returning capital to shareholders. Here they talk about the non-core portfolio divestment. Well, we know that by now it's higher than that. As of January 27th, the last mine, Porcupine, was agreed to be sold. Here they cite the share repurchases, but we saw it already, so I'll skip this section. That's an interesting one. Signaled by our joint venture partner, production from Nevada Gold Mines, and again, the partner they have is the Barrick Gold, which owns the rest of Nevada Gold Mines operations. So signaled by our partner, production from Nevada Gold Mines and Pueblo Viejo expected to significantly increase in the fourth quarter, which is crucial as these sites comprise just over 20% of our attributable gold production for 2024. So given that 2024 gold production is estimated to be at 6.75 million ounces, these 20% represent 1.35 million gold production just from those joint ventures with Nevada Gold Mines and Pueblo Viejo. All-in sustaining costs for the fourth quarter expected to approximately be $1,475 an ounce, which represents 8% reduction compared to third quarter. And this favorable decline is expected to be driven by higher gold production volumes and will be slightly offset by higher sustaining capital reinvestment. Again, we know higher production volume decrease denominator, which decrease all-in sustaining costs. Turning to development capital, we expect to spend $320 million during the fourth quarter, keeping us on track to meet our full-year guidance estimates. And we continue to expect to invest average $1.3 billion per year into projects that will generate the highest returns. So $1.3 billion in development capital and $1.8 billion in sustaining capital per year. Here are some closing remarks from the CEO of Newmont before the Q&A session starts. And he discussed the capital that was returned to the shareholders. I'll skip that because we saw it already. Here is more interesting stuff. And I find the statements that CEO makes here poorly worded at best and contradictory at worst. And there are two statements here that I think are contradictory. Let's read it aloud. Looking ahead to 25, we expect gold production from our go-forward T1 portfolio to remain largely consistent with this year, driven by lower than previously expected production from two of our new operations in Lihir and Brucejack. So the CEO says that we expect gold production to remain largely consistent with this year, but then immediately adds driven by the lower than previously expected production from two of our operations at Lihir and Brucejack. So lower production from Lihir and Brucejack would logically reduce overall output, not support consistency. To say production will be consistent because of weaker output at two of its assets is poorly worded at best and contradictory at worst. Another thing is when CEO says that the production to remain largely consistent with this year, we know that this year production is expected to be at 6.75 million ounces. So which means that for the year 2025, he expects production to be roughly about 6.75 million ounces, which is not the case. And let me show you why. Later, when he asked about the gold production going forward to 2025, the same CEO says that the 2025 number is more like 5.6 million ounces, but then it is not consistent with this year production, which is 6.75 million ounces. You get what I mean, right? It is just inconsistent. I was thinking that maybe he is saying that the total production will remain flat despite lower output at Lihir and Brucejack, but this would imply that the other assets will compensate. But this is not the case. It's not what we see, and it's not made clear here. Let's look at the second inconsistency. We expect unit cost for our core portfolio in 25 to align with the trends we're observing this year. Okay. We also remain committed to the critical tailings work at Cadia, which may result in an annual sustaining capital spend of around $1.8 billion over the next few years, and we continue to see higher than previously expected direct costs and general and administrative spend. Again, you're saying that you expect the unit cost to align with the trends that you're observing this year. Well, this year you have all-in sustaining costs at $1,611 and the guidance for the fourth quarter $1,475 per ounce. That would be considered alignment with the trends you're observing this year. But then you say that you expect the sustaining capital to increase along with the higher direct costs and general and administrative. So sustaining capital is part of all-in sustaining cost per ounce. So if you're saying that the sustaining capital, direct cost and general and administrative to increase. This will lead to high unit cost, not flat unit cost, unless it is offset by higher production, which again is not the case, as production is expected to be lower, as we can see. So I don't understand what CEO means when he says that he expects unit cost to align with the trends observed this year. This is definitely not the case, and there is inconsistencies in framing. I think CEO may be trying to reassure investors by emphasizing stability, but the statements as presented here contains conflicting signals about both production and cost trends, which I think could reduce clarity and credibility unless further detailed. There are more contradictory or inconsistent statements from the CEO. I'll show you in a moment. Let's look at the final paragraph. With this context, my leadership team and I have a laser focus on the work we need to do to optimize our go-forward portfolio of 11 managed operations. You see, 11 managed operations, not T1 operations, managed operations, and 3 projects in execution. Again, this is Cadia, Tanami, both in Australia, and Ahafo in Africa. There's also one in Cerro Negro in Argentina, but they are not part of 3 projects in execution. Whilst we don't anticipate production growth over time, our focus is firm on expanding margins, generating strong return on capital, and creating value versus chasing volume. We are taking a critical look at our organic projects pipeline and spend time to ensure that any reinvestment we make into our portfolio is both disciplined and deliberate. And here is the Q&A section. A question from UBS that I think partly tries to address the contradiction that we discussed previously. All-in sustaining cost was higher than you saw in February. Is it realistic and credible? I want to highlight this word. Is it realistic and credible to actually assume that unit cost will moderate over time? And here is again the CEO. And what he's doing, he's citing the strong correlation between the gold price and the cost per ounce, implying that the cost rise and fall in tandem with gold prices, largely due to inflation-driven input costs that affect the industry as a whole. Let's see it in more details. If I think about the gold industry, there's always been a strong correlation between gold price and the cost of producing an ounce of gold, given that inflation is one of these key structural elements behind gold prices. So if gold prices eases, they would expect the cost of producing an ounce to ease. So, okay, CEO suggests here a strong correlation between gold prices and cost per ounce. Okay, but later he acknowledges that the actual current cost increase are driven by lower production volumes and higher sustaining CapEx, not broad inflation. And let me actually show you that statement. I believe it's on page number 17, and I've highlighted in blue. There was a question from the Scotiabank. And the question was, is it fair to assume that the only industry-related cost is your labor? And here's again the CEO answering the question. And what he says is that the labor cost inflation rate is stable, so again that's inflation rate, and main cost drivers are lower volumes, higher sustaining capex, and not the strong correlation between the gold price and the unit cost. So let's read what he says. The 24 to 25 story is the volume story, and the sustaining capital story. Largely what you're seeing is the cost we're seeing this year for labor, whether it's being employees or contracted labor, staying about the same going into next year. So again, what CEO is saying here is that the drivers for the high unit costs are lower volumes and high sustaining capital, not strong correlation between the gold price and the unit cost. In fact, what he's saying is that they are not expecting the escalation in cost inflation rate. So again, this argument the CEO uses about the strong correlation between the gold prices and the unit cost is more long-term industry dynamic, and definitely not the current situation at Newmont. And in fact, if we look at our Excel when we made a P analysis for all-in sustaining cost, we can see that not every gold mine experience all-in sustaining cost escalation. So it's definitely more company related than industry related. Let me get back. So I think it is clear about the strong correlation between the gold price and the unit cost. We don't see the cost escalation that would be industry-wide, at least not to the extent that CEO tries to show here. The other paragraph, what CEO is saying here, because the question was about the early projections that were given in February. And what CEO is saying here that the forecasts were made under assumptions of no change in cost input or inflation rate during the specified future period. So what he says that in February they did not assume a change in cost input or inflation rate, and by that he tries to explain why unit cost projections for fourth quarter are higher than what originally was given in February. Let's read aloud. So RTA numbers that we had provided back in February assumed zero escalation. And so when you think about any forward-looking numbers, there is no escalation. And as we get closer to 2025, the run rates that's going to flow into next year, as we understand the cost. So what CEO is saying here that the ongoing observations of run rates and cost will be factored in for the upcoming guidance that Newmont will provide with the full year results. Here is Chief Financial Officer, add some granularity. The costs that we're seeing here in 24, we do expect those to trend into 25. Costs were higher driven by the higher direct costs, primarily contracted labor, which is 15% of our cost structure. Here we said that the contracted labor represent 20% of cost structure. Here CFO says it is more 15%. And we know that contractual labor represents 50% of Newmont's total labor. Here is a question from UBS again, and it's a question about the gold production going forward to 25. The question is that in February, you said that there will be 6 million ounces of gold from the core portfolio. And the question is it fair to assume that 350,000 of 6 million is the new base when we look into 2025? And here's the answer of the CEO. The number is more like, again, 5.6 million ounces from the core portfolio for 25. Again, this is 5.6 million ounces. We know that by now Newmont has only core portfolio because the non-core assets were divested. So this 5.6 million ounces for 25 is not consistent with this year, which again is more 6.75 million ounces. Here is a question about the integration issues, given the high cost mentioned across the project Lihir and Cadia. And remember, all those 3 mines were acquired as part of the Newmont acquisition. So that's one the question about the integration issues here. And they said that at Lihir it was due to the autoclave shutdowns. At Cadia it was higher power cost. And at Cerro Negro it's ramping up following the tragedy earlier this year, which leads to 2 fatalities. And here management cited the 2 impacts with going from 24 to 25. And these are volumes and costs. So there is volume impact due to the Lihir and Brucejack work next year. And there is cost impact from sustaining capital. And here's the answer of CFO, who tries to put some more granularity. So 1/3 is due to lower volume, another 1/3 is due to higher sustaining capital, and for another 1/3, half is higher royalties and half is higher general and administrative. So pay attention, no mentioning about the correlation between the gold price and unit cost. This is reality of what's going on at Newmont. So lower volume, which reduce denominator, increasing the all-in sustaining cost, higher sustaining capital, and higher royalties and general and administrative. So if we look again on our little table here, lower volume, higher sustaining capital, and higher general and administrative, all leading to higher all-in sustaining cost per ounce. And I won't read it here, but and you can read the section for yourself if you want to. Management acknowledges that they're not happy with where they are and they're working to reduce these costs. Here is a question from the RBC, and the question was in a nutshell about the inflation trends for modeling forecast. And the answer is in terms of the input costs around consumables, fuel and materials. That's largely in line with what the board is seeing, so there is nothing particularly surprising here. It is labor cost where we're seeing that the escalation, particularly the contractual labor, we're seeing some of those escalations come through. Here is this question that we discussed on the first slide, which is in a nutshell. Is this a 5.5 million ounce a year, $1,500 all-in sustaining cost type company going forward? This is the question as it was originally asked. And CEO mentions here that the labor cost escalation and increase sustaining capital related to tailings facilities at Cadia. So let's read aloud. In the outlook we've given in February, there was no escalation there. So as you make assumptions about what escalation, inflation may do link to what gold price may do. Yeah, and again, same story. And I said the key link between gold producers and gold prices, that's going to be pretty significant driver of the cost of producing an ounce of gold at Newmont. The CEO again tried to guide us to the key link between gold producers and the gold prices, which is simply not the case at Newmont. The case of Newmont, as we saw, is lower volumes, higher sustaining CapEx, and higher direct costs. Has little to do with key link between gold producers and gold prices. And he says here, as the gold prices softens and those costs come off, which costs come off, low sustaining capital. Sustaining CapEx is independent from gold prices. He is citing probably the labor cost escalation, but again, it represents only 15% of Newmont's cost structure. Again, I was not happy with the answer. Another driver of our all-in sustaining cost is the important work we are putting into tailings facilities and ensuring that we have a set of tailings facilities that have the appropriate capacity and structure to support these very long life operations. He is referring to Cadia here, I think. Yeah, this sentence, but there are periods of elevated spend in sustaining capital in any mining company. Yeah, I'm not happy with this answer, to be honest. So here's the Chief Operating Officer, again offering some granularity of run rate, and they're talking about the Boddington, Penasquito, Cadia and Lihir. So let's read aloud. I want to build a little bit on Tom's point on the 6 million run rate. And just as a reminder, Boddington is in 2 years of high stripping and lower than normal ounces. Again, stripping is the process of removing large amount of waste rock to access gold ore. So Boddington will get back to its normal production. Penasquito, we will start to see coming back in the new year. Cadia, we have been predicting all along that we will see the lower grades coming through. Yeah, lower gold yields is what we're gonna see more and more in the future, I think, not only for Newmont, but for other gold miners. I think gold prices going forward will be higher, because as you get the lower grades of ore, lower gold yield, you would need the gold price to increase to make the more expensive production economically viable. But as of Panel Cave 2-3 comes in during the next 2 years, we will see Cadia production step up, and we saw already this 2-3 projects, Panel Cave 2-3 development, so it's expected to bring 1 million of gold ounces over the next 10-year cave life, and the peak production I expected from 2027. And CEO adds that Ahafo North will start to produce gold in the second half of the next year, so second half of 2025. Here are some congrats on getting the synergy target achieved of these 500 million, and the question was how much of that flows through the OPEX, operating expenses. And the answer was that important part of closing out the integration is completing our investment and having a clear line of sight to 11 managed operations and 3 projects in execution. Again, Tailings Expansion 2, Ahafo North, and Panel Caves 1, 2 and 2-3 at Cadia. And here CEO reiterate the point that the fourth quarter is going to be a very strong gold production quarter. Here is the question about the labor inflation, and again I found a bit contradictions in how management is answering. So the question was that yourself, Newmont, and some of your peers budgeting approximately 4% labor inflation for 2024, and the question was, well, what's the realized experience in terms of labor inflation? So is this 4% labor inflation realistic for the 24? And the CEO does the breakdown of costs. He says that 50% of labor sees 4% inflation, and another half, that is contracted service, has escalation. So let's read what the CEO says here. In our direct cost, half of the cost is labor, about half of that is our employee base, and that's the 4%. So on the employee base, which represent half of Newmont's labor, they see the inflation of 4%, which is in line with expectations. The other cost base is the contracted service for use, whether that be maintenance, shutdowns, maintenance that you use to supplement your workflows, cost of running camps, cost of flying people to and from mine sites, etc. And that's where we're seeing some escalation beyond what we had assumed at the start of the year. Later, the CEO will say that for the contracted service, they see cost inflation of around 12 to 14%, and they don't expect escalation further going into 2025. That was the question about the production from T1 mines, and CEO says here that there will be lower production from the Lihir and Brucejack. We saw it already, right? In terms of pretty significant movers in our managed portfolio. And for the rest of operations in going forward portfolio is where you see the run rates seen throughout the course of this year flowing through 2025. So that's why I said that statements of CEO are inconsistent. In the beginning, CEO said that they expect gold production from go-forward portfolio to remain consistent with this year. And I said that given the low production expected at Lihir and Brucejack, the only possible way to have the flat production is if you increase production in other operations, which is not the case. You have low production in Lihir and Brucejack and same run rate for the rest of portfolio. And here CEO says that our growth is in margins, not in volume. And I'm asking here how likely that is that you're going to improve your margins, where these improvements will come from. We know that Newmont has higher sustaining CapEx for Cadia. This will last a couple of years. We see some contractual labor cost escalation ranging from 12 to 14%. So I'm wondering how likely and when are we likely to see the margins improvements for Newmont. I'm pretty sure it's not going to be the fourth quarter of 24, and I don't think it's going to be the 2025. And here's again the question, we'll discuss it partly. What cost is Newmont related and what is industry related? And what this analyst is doing is she's pushing against what CEO Tom has said. She says that understand that what's Newmont related in this cost have to do with your particular operations on volume, which you've given us some lower volumes at Lihir and Brucejack, and then you've given us the additional sustaining capital. So the analyst is asking here, is it fair to assume that the only industry related cost is your labor? And for contractual labor, the inflation is 12 to 14%. And the answer is that the labor cost inflation, whether it's employee or contracted labor, staying about the same going into next year. And the main driver is lower volume and sustaining capital. So then analysts ask again, am I correct to speak to how that 12 to 40% inflation in your contractors, has that not changed? And the answer is that we are not seeing a step up of that sort of percentages, so 12 to 14% you're talking about. As we close out the year, we're seeing that flow into 2025. So no labor cost inflation rate escalation there. Here was the question from the same analyst about the Cadia, given that management has been saying for a long time that at Cadia they expect to get lower gold yield and lower production. So the question was about the production level at Cadia, given the projects in execution. And the answer is that as Penalty Cave 1 and 2 comes the end of the life, we see lower grades coming through, and they will continue to see that going into next year. So again, Cadia is a mine located in Australia. It will see lower production and lower gold yield. At the same time, Penalty Cave 2-3 is now ramping up. So we will slowly ramp up that over the next 2 years to full production, and Penalty Cave 2-3 will then start to replace the lower production from the Penalty Cave 1 and 2. And then Penalty Cave 1-2 is only targeted towards the end of the decade. So when we saw Penalty Cave 1-2, production will start in 2030, and for 2-3 it will start in 2027. So yeah, don't expect higher gold production from Cadia in the near term. And that wraps up our earnings call walkthrough. I have promised to do a walkthrough for the gold mining and processing, and to use Lundin Gold as an example. We are talking about the Fruta del Norte mine here, where Newmont holds 32% minority interest. And if you want to access what I'm about to show you, go to Lundin Gold website, so it is lundingold.com, go to operations and scroll down until you see the interactive content. You'll see the little button that says View Presentation. Click this button and expand it. And we have interactive presentation of Fruta del Norte operations, which we're gonna walk through. Let's read this part. Fruta del Norte deposit is located within 150-kilometer long copper gold metallogenetic subprovince located, I won't be reading this name. The nearest city to Fruta del Norte is Loja, the fourth largest city in Ecuador, and you can see the city here. Here we have Fruta del Norte operations, and if we have a look at the legend, we see by orange we have exploitation area, and by yellow we have exploration area. So Fruta del Norte is this small part of the area. Here is the regional infrastructure. So again, the exploitation area is only here. The rest is exploration area. And in purple you have concentration material concessions. And this refers to a permit or right granted, well, usually by the government, to extract materials like sand, gravel, rock, clay, which is needed for building and maintaining mining infrastructure. So that's what these construction material concessions refers to, as can be seen here. And we can see that Lundin Gold properties consist of 27 metallic mineral concessions and 3 construction material concessions. We can see by green the north access roads and by blue the power transmissions. Here is the site overview looking west. So that is how typical mine operation looks. So this is the looking west, and here we have looking east. And there are some things here we are familiar with. Paste plant, for example. We know where we use that. And we have the jaw crusher and processing plant. Let's click on the processing plant. And here is the processing plant of Fruta del Norte. So let's have a look at the jaw crusher. We can see the trucks unloading the ore that is then crushed in the jaw crusher. We can see here a mine stockpile, and then crushed ore is moved further using the belts, and it's moved further to the stockpile. So here is our stockpile, which is then moved to the processing, and here we have ball and SAG mills as the first step for the grinding, but we'll discuss it in a moment. Let me get back. And you can interact with everything here. You can press, you can move it, however you want. Here we have relief map of Fruta del Norte site. So here we have a topographic map of the site. And if we go further, we start to see the tunnels, which means that there is ore body somewhere nearby. And if we go down, we can see there is a ore body underground. And this is the ore body which we're gonna discover now. So again, we went from typographic map to the ore body, and then we're gonna look at the geological model. FDN deposit is an intermediate sulfidation epithermal gold-silver deposit measuring approximately 1670 meters along strike, 700 meters down dip, and between 150 meters and 300 meters wide. The deposit is truncated by a fault to the west and north, while the southern limit of the mineralization has not been fully defined. And here we see those faults: east fault, west fault, and central fault. And when a deposit is truncated by a fault, as is the case here, it means that a fault, which is a fracture in the earth crust, has cut through the mineral. So you can see that the earth's crust has cut through the mineral, and you can think about it as a sandwich cut in half, and one half is shifted. So the ingredients are still there, but no longer aligned. So that's what those faults are. Let's read further. Mineralization is moderately refractory, so this is refractory ore, with approximately 40% of the gold locked in sulfides. In the high-grade part of the system, coarse visible gold is commonly observed with individual gold grains ranging from discrete spheres less than 0.1 mm in size to broccoli-like arborescent crystals more than 10 mm across, visible with naked eyes. So this is an example of gold cores, and we said that on the industrial level those gold nuggets are extremely rare. Well, Fruta del Norte is one of these rare examples. Now let's deal with the rock unit from the legend, and I am by far not the expert in geology, so I will mention some characteristics from economical perspective. Starting with feldspar porphyry in purple, we see it here. It is large-scale, low-grade mineralization formed from magmatic fluids. So this type of rock usually have broad zones of precious metals over hundreds of meters, and profitability here is reached due to bulk tonnage mining because it has low grade. Next, Soares conglomerate. It can be characterized as coarse sedimentary unit, and coarse means big fragments, and sedimentary means that is formed from particles deposited by water, wind, or gravity. This type of rock can act as a host for mineralization or barren layer, and barren layer is a rock unit that does not contain economic mineralization, meaning it has no valuable metal. Next we have undifferentiated volcanics, mineralized, and mineralized means that rock contains economically valuable mineral. We have it here in yellow, fragmented by a fault. Often it is altered and fractured, meaning it has good permeability, this is very important, may host disseminated or vein-style gold or silver, and disseminated means that tiny gold-silver particles spread throughout the rock, and vein-style means that gold concentrated in narrow cracks, called veins. It is potential secondary ore zone. And then in black we have undifferentiated volcanics, unmineralized, and unmineralized means that rocks has no significant concentration of valuable mineral. So it is same as above, but no economic mineral content. So when we said that undifferentiated volcanics is potentially secondary ozone, the key target for drilling is usually hydrothermal breccia with abundant veining, and it is listed in red here. And if we scroll to our deposit, you can see this tiny fraction. And this is hydrothermal breccia with abundant veining. It is often at core of mineralized systems. It has excellent permeability, meaning there is a strong fluid flow. And excellent permeability means that geological unit allows fluids like water or hydrothermal fluids to flow through the ore body easily. And these fluids dissolve metal like gold or silver, transport them and deposit them in cracks as they cool, forming ore vents. So in fact, this is how gold vents are formed. It is a key target for drilling high-grade ore. And you will see that when we get to the resource and reserves, the reserves are mostly represented by this part of the ore body. We have this hydrothermal breccia because it is a key target for drilling high-grade ore. And by dark brown, we have pre-athomagnetic breccia, and it is formed by explosive magma-water interaction. It has high fracturing, so it has good fluid pathway, and it may contain mineralization. However, it has a variable grade and it needs detailed analysis for the confirmation. This rock is represented by light brown color here, this part and that part. It may contain mineralization and it has variable ore grade. So remember, I said that this part of the body, which is hydrothermal breccia, is usually a key target for high-grade ore. Now have a look. When we shift to mineral resources, what do we know about resources? We know that inferred resources have lower confidence level and indicated have higher confidence level. Where is the indicated resources located? On this part. You see? This part. This part was represented by hydrothermal breccia. So this is the breakdown of how inferred, indicated and measured resources are classified. So here we have our mineral resource. So it's 1.6 to 0.4 to 0.7 kilometers. And as of December 2015, there were almost 24 million tons of indicated and 11.6 million tons of inferred resources at an average grade of 0.6 gram per ton. And of course, 9.6 gram is very high gold yield. So we have inferred resources that have low confidence. We have indicated that have medium confidence. And if we move further and introduce not just geology, but also economics, we'll get to reserves. So here we have probable reserves that are a subset of indicated resources. So reserves are always smaller mineable portion that passes economic test. So not just geological test, but also economical test. So this is how we derive to inferred and indicated resources than to probable and proven reserves. Here we have declines and SVR accesses, and SVR stands for service vehicle roads. So we had an ore body here, and pay attention, we have here reserves, and when we look at the declines, those declines penetrate the reserved section. The primary mining method used at FDN is transverse long-hole stoping, and this is an underground mining method used to extract ore in steeply dipping wide ore bodies, typically more than 10 meter thick. And it is a type of long-hole stoping where holes are drilled horizontally across the ore body. So if you zoom it in and look at the tunnels, it is drilled horizontally across the ore body. So we had an ore body here and we drill those tunnels horizontally. Thus the name transverse long-hole stoping. And blasted ore falls into a draw point below and is removed, and stopes are then backfilled after mining. So you can see here paste backfill is utilized to fill the exhausted stopes, and later in the mine life cemented rock fill will be used as an auxiliary method. So we have here a decline, right? And here we access the ore body on the different levels. So we're gonna charge and blast, for example, this part of ore, we're gonna unload it, backfill it, and then start mining out next section. And if you really want to understand this transverse long hole stopping method, go to YouTube and type in transverse long hole stopping. And open the first video, which is done by Epiroc Underground Mining and Tunneling. Now I won't show the whole video because I don't have a right to do that, but it is exceptionally good video that explains how the underground, how this process looks. So they're showing how the decline is, how the shaft is done, and then they explain the method, and then there are those tunnels that goes across the ore body that we saw at Fruta Norte, and I believe here they explain the method. Yeah, so you're gonna mine this section, backfill it, mine that section, backfill it, this section, backfill it, and then you go upwards. Again, very good video. I highly recommend looking at it. And here they show how the backfilling works. So they're gonna charge the tunnels, then they're gonna blast them. So they're charging and blasting, and this ore body, then you get the loaders that unload this ore body, and then you do the same for the next section. Again, I highly recommend looking at this video. It is by Epiroc Underground Mining and Tunneling, and if you press on their channel, they have loads of information, very high quality information with good animations, visualization of the gold mining process. Epiroc Underground Mining and Tunneling. So I guess that explains those tunnels that are drilled horizontally across the ore body. As of September 22, 40 kilometers of underground mine development have been completed. The 13-year life of mine plan progresses from 2020 to 2034. And this is the life of mine plan, 2021, 22, 23, let me maybe move it like that, 24. Then we get to the current period from 25 to 29, right? And now they're mining just western part of the ore body, which we saw previously was separated by the fault. So it was one fault here on the west and one on the east. And they haven't even started accessing eastern part of the ore body. And here we have the portals, Kisa and Kuri, and we actually saw them previously. Let me just back up a bit. Here is the Kusa decline and here is the Kuri decline. And let's dive a bit deeper. Here we have a loader that carries the blasted ore, and here is the net with the rock bolt that are long metal rods inserted inside the tunnel to reinforce it. And this is rescue chamber, so in case of emergency, workers can wait for the help to arrive. Chambers include oxygen supply, it includes the CO2 removal system, food and water, communication equipment, so pretty much everything that you need. And I believe rescue chamber can provide supplies for up to a week before the rescue team can arrive. And here is the exterior of the rescue chamber. Here is resources development conversion drilling. And conversion drilling is ongoing and aims to convert inferred resources to measured and indicated resources. In other words, increase confidence level for our resources. And they have in white the current resource conversion and expansion, and in purple have proposed resource and conversion and expansion. So white is current, and you can see the purple here. They want to access this part of the ore body to turn the inferred resources to measured and indicated resources. And that's how the conversion drilling looks. So we have 1800 meters of underground drilling across 88 drill holes, the result of which have improved confidence and further support the geological models. That's how it looks in real life. And here is the processing plant. So we spent extra time in gold processing, and they say here that processing at FDN is achieved through gravity flotation leach circuit. We've explained every step from the circuit, and this is the processing plant, and I have here process plant flow sheet. Let's click that. And if you're wondering where I took the flow sheet that we've been using previously, well, now you have the answer. So let's remind ourselves quickly. We have a coarse ore stockpile here that we're gonna load to the jaw crusher to get the crushed ore stockpile. We're then gonna flow it to the SEG mill, which stands for semi-autogenesis mill. The free coarse gold particles that are not chemically bound will undergo the gravity concentration, and we haven't discussed that, but this is the method to recover coarse gold or free gold that is not bound to other minerals, and those can be recovered by gravity separation. Of course, gold being denser material, so those denser gold particles will sink while the lighter gang is washed away. And once this is done, we skip the electrowinning process altogether because we don't need it. We have the free coarse gold particles, and now we're gonna refine it and get the gold door. However, the largest part of output at Fruta del Norte is gold concentrate. The concentrate still has gold locked in the sulfides, so that's why they are not using the pressured oxidation here, although they mentioned the carbon in leach circuit, elution and electrowinning. So probably a small proportion of the gold they produce undergoes the carbon in leach circuit. That was the milling up until here, right? And here is the flotation. We use this method also to produce the concentrate. So we have here concentrate thickener, for example. And here we have our base backfill and tailings storage facility. But let's have a look how this process looks in real life. So we begin with the jaw crusher. We have run of mine stockpile here. We're gonna load it to the jaw crusher, and then it's gonna go to the stockpile. Now this ore is referred to as coarse ore stockpile, and is then fed to the primary SEG mill, semi-autogenesis mill. So it is fed to a cyclone cluster, which is enclosed circuit with a gravity concentrator and a ball mill. And here we have the gravity circuit, which is essential to recover the coarse free gold and small amount of fine free gold. Let's have a look at the flotation cells. Consist of 3 stages of flotation and regrind. It's capable of recovering the gold associated with sulfides, pyrite, we saw that. It reduces spikes in sulfide gold grades and provides consistent feed to the carbon in leach circuit. So again, we do flotation to ensure consistency. And here are the concentrate filters. So up until now we had a slurry, and we have this concentrate that is now thickened and filtered. And here is our output gold concentrate. Again, the gold is still locked inside the sulfides, and then it's directed to a third party, whatever this party is, that then uses oxidation, cyanidation to recover the gold in the form of doré. Here is the leach circuit. So slurry is leached with cyanide in a series of carbon in leach tanks. Loaded carbon generated from the carbon in leach tanks is pumped to the carbon elution and regeneration circuit. Then the reactivated carbon is reintroduced to the carbon in leach circuit. Gold elute is sent to the electrowinning cells using the stainless steel cathode to produce gold-silver sludge. It is then smelted to produce gold-silver doré. And this is the paste plant, which provides the backfill material required for mine stability during operations. And the input for this paste plant is the tailings. So the tailings received at the paste plant are dewatered through a series of dewatering technologies. So we have here filters to achieve the final moisture content of 20%. We have mixers here. And here we have paste pumps. So cemented paste fill drops from the mixer into a paste hopper. A piston pump then pumps paste fill on a continuous basis down a drill hole for deposition undergrounds. So that's how we use the tailings in a paste backfill plant. This is La Pena camp for the workers of Fruta del Norte. We have a gym here. Nice. Although I'm wondering how you can do exercise here. Oh, probably it's open. Oh, look at that. I thought it's maybe open air gym, but no, it's a dedicated gym. Alright. That's cool. And this is the tailings storage facility. Approximately 40% of the tailings generated are converted into paste backfill, and the remainder is deposited into this tailings storage facility. The tailings storage facility is downstream dump facility and is continuously monitored. Yeah, you have to continuously monitor it to avoid 1.8 billion in annual sustaining capex, right? I'm gonna skip that. And near mine exploration targets, that's an interesting one. They are testing several unexplored opportunities near their mine sites. Indication from drilling in 22 suggests potential for the extension of FDN mineral resources at depth, as well as to the east, west and south of the current mineral resource envelope. So if this is our current ore deposit here, they wanna do the new mine exploration on the northwest and northeast. And you can see those explorations are limited by the fault. You know, that's why I said here when we discussed the P analysis for Lundin, I said I'm not particularly concerned about the high ratio of enterprise value to reserves, because there is loads of potential going forward for Fruta del Norte operations. And this is the regional targets in the Suarez Basin. So by red star we have epithermal gold-silver targets within basin, and by blue outside basin. And take a look here. Lundin Gold believes that the Suarez Basin is a highly prospective structure for hosting additional epithermal ore deposits. And I think if we click further, we have a sampling here. So we see there is higher potential, not at just Fruta del Norte mine, but also at other operations, as shown by the red dots. And I think we're getting to the end. Yeah, here are some slides about the local communities, about the cultural center. And here we have Yansaza city. Yeah. And I believe Lundin Gold was also involved in the building of the intensive care unit. So Lundin Gold partnered with SolGold and Newcrest, we know those guys, right? Newcrest, to build the first intensive care unit in the province of Zamora, donating 136 medical devices to benefit approximately 91,000 people. Yeah, so that's it for the gold processing walkthrough. I strongly encourage you to go to this website yourself and play around and explore for yourself. So again, this is the Lundin Gold operations and then this presentation. And that concludes our presentation.